So, hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj, and in this session, we are going to discuss FM's RTP, which is basically your September 2024's edition, right? So, before we get started, a few quick ground rules for this particular session. So, the first thing is, I am making a very reasonable assumption that you have at least gone through or studied this entire subject once, right? Only then this is going to be super effective for you. So basically what we are going to do here is we are taking RTP as the base and we will be discussing all the issues that are present in this particular attempt's RTP, and of course wherever possible the background concepts, everything will be done. Clear with this? And as I mentioned, this is actually a revision, right? So we will be giving an overview. I'll be giving you guys an overview and I expect participation from your side, and once that is done, so we will be proceeding forward to the numerical problem. So then and there I will be doing it, and don't worry, the strategy might not be the same for every single question. For certain questions I'll have to give you the background and then move to the question. For certain questions we will jump into the question and then during the course of solving we'll be doing the background, right? So this is how we are going to do it. That is number one. Number two, so even for the ones who are watching it on YouTube, so please have a calculator with you and a notebook and a pen. Basically this is done. I mean, I'm asking you to do this because I want you guys to do the calculation. There is nothing like, I will be showing the figure and you will also say, yes, I have understood. We are not doing something just to get a feeling of understanding. I want you guys to do it along with me, right? So I'm going to pick the answers from you and make sure that you are participating, right? And number three, the most important thing, see, right now whatever you guys are preparing, you are doing this preparation, this time that you are investing is for the day before your exam, not for the exam altogether, because the day before your exam you need to revisit the entire subject, and what is not revised is as good as not done, right? So now for you to recollect this entire RTP, right, you need to take proper notes, and I have something called as library of adjustments. If you have attended my costing RTP session, I had mentioned the same thing, which we also follow in our regular lectures, right? So what we will do is, for every question we will try to capture what are the unique adjustments that we have learned in this particular question, just so that the day before your exam, when you are revisiting the RTP, it will just take about 10 to 15 minutes to cover the entire RTP, because that is all you will be having the day before your exam, right? Fair enough. So when it comes to this library of adjustments, I would like you guys to maintain it in a certain format. So this library of adjustments, what you can do is, you can just open your notebook and you can have this tracker column. So have this as question number, type, chapter and concept. Leave a big space for concept. Now basically what we are going to do here is, in your RTP you broadly have four different types of questions. One is called a case study based MCQ, right? Then you have a standalone MCQ. Standalone MCQ is like one question and pertaining to that four options. Case study based MCQ, one full-fledged case study will be given. Out of that, 5 different MCQs, each carrying 2 marks, will be asked for, right? So this is case study based and standalone MCQ. Apart from that, you will be having descriptive questions, basically your numerical problems, and finally you will also be having one theory question in your RTP, which is like direct, right? So this is all about your RTP's pattern, right? So that gets captured in this type column. So question number, as you all know, and from which chapter it comes from, and this is where I will be dictating you, right? As and when we finish a sum, this is like a scoreboard that we maintain. We will come and we will populate whatever we have learned here, so that the day before your exam, if you just look at this library of adjustment table, you will be able to revisit this entire session, whatever time that you have spent. Clear with this, guys? Whatever you do, give yourself the best worth for the time that you spent, right? No matter for which subject it is, right? If you have something like this, it will be easy for you to actually revise the day before your exam. Clear with this, guys? So that's about the initial stage, that is before we start into the RTP. So now, can we get started, guys?
Yes, sir.
Yes?
Yes, sir.
K-class, Satama?
Yes, sir.
Right, so let's get started, guys. Come on. Yes, so please take your RTP, soft copy or hard copy or whatever it is. Please take the RTP. Now let's get started with the first question, the only case study based MCQ in this attempt's RTP. And it has come from the chapter Investment Decision. Fine, guys, shall we get started? Yes. I want full attention, full focus. Now, before we start, I want to give you one background and disclaimer. Please don't get afraid by reading this question, right? This is where many students fail. This is where many students are finding it difficult. You know what? This question actually is ideally not a 10-mark question. It's in fact much more than that. This is just a case study. Apart from that, they have built some questions here, right? Fine. So now what happens is, the moment you look at the length, you need not even read. The length itself is enough for you to break the confidence. Imagine your exam hall right now. This question comes in. First question, what will you do? You will not read. You will break down, right? So always remember, this is what I tell myself, this is what I tell my students also. CA exams are a test of your emotions. It's about the people who are mentally strong. Prepare yourself for that. Work on your mind game, right? And then you can work on your exam preparation and all that. First, be strong here. Now, how many of you find case study based MCQs to be lengthy? Honestly, come on guys, quick. Yes, almost everyone, right? So there's one hack that you can do. This is similar to the same as what I told you in your costing RTP discussion also. Now don't read the case study first. Directly jump to the 5 questions that they have asked. Sir, how can we answer it? I'm not asking you to answer anything. Quickly browse through it so you will know what they are asking for. Now in an RTP, they have given which chapter it is being tested from. In exam, they will not give you all this, right? So first you should identify which is the chapter they are testing. How will you know that? Not by reading the case study, but only by reading the questions. Ultimately, you get marks only for this, right? Directly skim through it. First, what have they asked? Calculate the net initial investment, right? So which means there is some calculation revolving around your initial investment. NPV of the project, this clearly tells you that this is a capital budgeting, investment decision sum. Then they are asking you for payback period, estimated recurring accounting profit or loss. Nothing but annual profit they are asking, that's all. Recurring, obviously profit recurs, it happens every year, right? For the first 3 years they are asking IRR of the project. Clear with this, right? Clearly this is what? A capital budgeting sum. Fine. Now if you read this first, you will know what to look for while reading the case study. Else what happens, you will first read the case study, then you will read the 5 questions, then once again you will go back and read the case study. It's a waste. Then why did you read it first? Correct, right? At least little time we can save. Clear with this, guys. But this is a very big question in my opinion. This should be definitely for more than 10 marks. It's not a 10-mark question and all, because after having done, you will feel, having done the entire question, first to 4 parts, you will be very tired, and then you will look at calculation of IRR. That is like one 10-mark question by itself, right? So that's how it is. But please, that's why I'm saying, I'm giving you all this background because you should not carry this forward to the next questions. Okay, this one question is like that. And I sincerely feel that for calculating IRR, they will give you some hints like NPV at 15%, NPV at 20%, and you just need to do the interpolation. I think that's all they will do. Here they have not given all that. Okay, so don't worry about it. I think if this comes in the exam, definitely they will be having to giving all that. Clear with this, guys? Now, shall we get started?
Yes, sir.
Yes, fine. So now, look at this. Mr. Ronak, a doctor by profession, has his own private hospital at Goa, having specialization in cardiac treatments. So basically, this is something to do with what? He's a doctor and there is a hospital that he is running. Clear with this? However, nowadays, Goa not being a place for tourists, but is also a place for business delegates, cultural peoples, politicians, students, and other classes of people. Gradually, Goa is opening new windows for businesses and getting recognition as an important tourist and a leisure hub for Southwest India. So this is basically like how you guys write answers in your BCom exam. They have given some irrelevant data. But look at this. There are a number of hotels and resorts in Goa. First paragraph, they're talking about hospital. This guy is a doctor. We were thinking all these things are relevant. Second paragraph, what they have said, number of hotels and resorts. right? However, the need still exists for more hotel services, in particular with excellent service, and because of large number of visitors from all over the country and all walks of life favor go. Okay, fine. All these things are there. Mr. Ronak, although being a doctor by profession, is contemplating to establish a 5-star hotel. This is the first line. So basically, the first 2 paragraphs are not at all required. Anyways, it is time consuming. Now, can you understand? This is just done to break your confidence so that it becomes lengthy. Guys, this is not even required. Who is bothered about what this guy is doing? Right? So he wants to start a 5-star hotel. So this sum is not hospital related. This is hotel related. Clear with this? Right? Fine. The hotel will consist of 5 floors. The hotel will include 40 normal rooms and 8 deluxe suites, as well as a restaurant and a couple of conference rooms with a small wedding hall on the ground floor. So basically, this is what they have. Some normal rooms, deluxe suites are there, and then there is a restaurant, and then conference hall with some conference room with some wedding hall and all. So this is what he has planned for. The following are the estimated occupancy rate, including the fare compensation in the table 1. Being a 5-star hotel, breakfast would be complimentary, but lunch and dinner are on an a la carte basis. Fine. A la carte is basically, everyone knows, for the benefit of those who do not know, it's basically like you have to order and get it. Whereas your breakfast is complimentary, but I don't think all of that is relevant for anywhere in the question. Right. Now, so they have given table 1, hotel accommodation, estimated occupancy. So basically, these things are important. Right. So now what they have done, they are going to build a 5-star hotel. This hotel has some 40 normal rooms, right? 8 deluxe suites. Then you have conference with wedding hall. Basically, don't say conference hall, wedding hall are 2 different things. Conference hall with wedding hall, right? That's one. Okay, they have 2 such conference cum wedding hall, and there's 1 restaurant, right? Occupancy rate they have given 33% or 120 days. What is that? So basically, what they have done is, look, there are 40 rooms here, right? On an average, only 33% of the rooms are occupied. Clear with this? So now what happens in a year? How many days are there? 360 days. Okay, so basically what will you do? Room days calculation. This is similar to service costing, right? They have linked it here. So you have 40 rooms, right? And not all the 40 rooms are occupied. Only 33% of them are occupied, right? Every day. Like that, there are 360 days in a year. Correct, guys? Now what they have done, this alone they have multiplied and they have mentioned it here. Are you clear with this? So this is 360 into 0.3333. You do it. You get how much? 119.999, round it off. It's actually 120 days. Are you clear with this? So do not confuse yourself. This is all they have done. So basically they have eased the calculation for you. Don't confuse it. So what you can do directly, if you multiply this with whatever days is given here, you will get the room days. Clear with this? And multiply that with the tariff, you will get your revenue from this particular line. Clear, guys? Any problem here? Yes, fine. They have given the average rent per room per day. Clear with this, right? And the growth rate in rent is 12%. What it is, we will see. Similarly, for deluxe suites, they have 8 such suites and 33% occupancy. 25,000 rupees is the per day room tariff, and the growth rate in rent is 9%. Conference wedding hall, they have 2 such rooms. 2 such halls. 40 days. Here they have not given all this percentage. They themselves have directly done it. So what you need to do for arriving at the total revenue from this, or for cost calculation, whatever you do. So 2 into 40, directly you will get the total number of room days in a year. Correct? From coming from this conference hall, multiply that with 3 lakh. 3 lakh rupees is per day, per room per day, or per hall per day. Clear with this? Right? And the growth rate is given. And similarly, restaurant, they have given its there's 1 restaurant. There is no such concept of room days and all. They have just sent 27,000 rupees is the sales per day. Clear with this, guys? And the growth rate is going to be 8%. What is that? We will see later on. For the sake of simplicity in calculation, the growth rate to be applied only after completion of 10 years. Right? So maybe after 10 years, there is going to be an increase in their revenue. This is all they are saying. Right? Up to 10 years, revenue from these things will be the same. Clear with this? Next, the estimated cost of land will be 250 million. Now, 1 million is equal to 10 lakhs. 250 million is equal to, just remove 1 0, it's going to be 25 crores. Clear with this? Right? See, these things they have done because here they have mentioned in millions, then here they are mentioned in lakhs and all. Don't confuse, be very clear about this. Because of this, you should not lose any marks. Okay, so it's going to be 25 crores, 250 millions, and the construction cost will be 100 million. Right? The estimated salvage value at the end of the 15th year will be 25% of the cost of construction. So basically with this you can get an idea that the life of the project is going to be 15 years. Clear with this? Then the cost of furniture will be 1,50,000 for each normal room, 3,80,000 for the deluxe suite. The cost of furniture for each conference room and the conference room with wedding hall will be 7 lakh each, and the restaurant it will be 10 lakh. So basically what they are saying is they have this land purchase cost, then they have this building construction cost, then inside you need to have furnitures. Furniture depends on the category, right? So for normal rooms there is one cost they have given here. Yes, so it's going to be 1,50,000, right? There are 40 such rooms, correct? So here for furniture, immediately what you can do, you can say, so for furniture for normal rooms it's going to be 1.5 lakhs into 40, right? Then for deluxe suites it's going to be how much? 3.8 lakhs into 8. Then for conference room it's going to be how much? 7 lakhs into 2, right? And hotel, how much is it? Yes, that's going to be 10 lakh into 1. Are you clear with this? Second. Yes, 10 lakh into 1, right? So this is going to be your total furniture expenses. Clear with this, guys, right? Everywhere they are not giving anything directly, you need to do the computation. Fine. Then in addition to this, the hotel will require 4 elevators at different locations, and it will be costing around 35 lakh each. So basically you have elevators also. Elevator is basically your lift, right? So that's going to be 35 lakhs into what? 4. This is what is required. Then the cost of buying and installing electronic appliances like TV, AC, fridge, etc. would be 35 million, right? So again, so now they have given that electronic appliances, it's going to be a total of 35 million. See, whatever is in this paragraph, we are just putting it, right, so that it's easy for us. Once again, we need not come back and read this entire paragraph. Then elevators would be depreciated at the rate of 5%. So elevators, the depreciation rate is going to be 5%. Then electronic appliances will have a salvage value of 15% of its acquisition cost at the end of 15 years. So here it's going to be a salvage value of 15% at the end of 15 years. Correct? You know, roughly we are just noting down whatever we are reading. That's about it. So that it will be easier for us, relatively easier for us when we are solving the solution. Then the hotel will be built by a renowned builder named Harrier Infrastructure. The builder estimated that the building will survive for 15 years. The required, again, so now the building has a life of how much? Okay, so we didn't note that down. So here first the land will cost how much, guys? Come on, participate and tell me. 250 million. Yes, and then there was a construction cost, the building. The building construction cost is how much? It's going to be 100 million, right? Again, it has a 15 years of life as mentioned by this guy, and they have said that it has a salvage value of how much? 25%. We are just collating the facts readily. That's all we are doing right now. Clear with this? Yes, it is a lengthier sum. Do not worry about it. Do not worry about it. It comes only by practice. Fine. Just answer to whatever I'm asking for. That's more than sufficient for the time being. Fine, guys. The other sums are not this time consuming. First sum alone, it's going to take some time. Fine. Then where were we? Yes, 15 years they have said. The required furniture will be supplied by a local reputed. Why do we need the name and all? It's not even required. They have given it. So they ensure that the furniture will go for 10 years very smoothly. Okay. So the furnitures, they have said that it will go for 10 years. But wait, it comes with a rider. At the end of the 10th year, new furniture for normal rooms and deluxe suites will be bought, and the old furniture for the same will be sold by the hotel owner, right? Now the owner of the hotel estimates that he would be able to purchase the required furniture at 15% higher price than the previous purchase price. So what happens at the end of 10th year, he is going to once again purchase all these new furnitures, right? It's going to be replaced, but now when he is purchasing, what will be his outflow? 15% more of what he initially paid at year 0, correct? So 1.15 of the initial cost will once again be an outflow there, right? Clear with this? The salvage values of the furniture at the end of 10th year will be 5% of their purchase prices with no book value remaining, right? The furniture at the restaurant and conference and wedding hall will not require any major changes as such, except for a minor renovation which will cost 20 lakh in total at the end of 12th year. Any scrap generated on account of such renovation will be sold at 1,75,000. So 20 lakh minus 1,75,000, how much is that? 18.25 lakhs, right? So the net outflow of 18.25 lakh is what they are planning for with respect to what? That banquet hall, that is the wedding hall plus what do you call that? Restaurant, right? They are planning for renovation. That is separate. That is not salvage value. That's a separate outflow. Clear with this? See, basically you tell me, is there anything technical about this? The facts of the data, they have made it so complicated and lengthy, so that they are literally testing your your mental stability. That's all it is. That's all it is. So what you need to do is, this is what you need to just collect the facts separately. Make sure that you are not missing out on anything while doing the sums. Clear with this, guys? It is not technically difficult. It is just that you can miss out on many factors, many aspects of the question when you're solving. That's all about this question. Clear with this, right? So, and here they have mentioned the salvage value is 5%, right? So let me just put it here. For furniture, at the end of 10th year, the salvage value is 5%. Huh? Yes, but this 5% is applicable only on these two, right? That is for normal rooms and your deluxe suites. Correct? For the other two, what they are saying, it's going to remain, but then only some renovation activities, separate outflow is being done, net of its whatever scrap income that they are generating. Clear with this, guys? Fine. Then, in order to boost the tourism industry at Goa, the state government will be granting 15% on the initial capex incurred, right? So whatever is the initial outflow, on that 15% government is going to fund you, which means only 85% of the initial cost is going to come out of your pocket. That will only be considered as an outflow. Clear? Any problem? Next, it will be paid at the time of the cost. It will be paid at the time of cost incurred. Plus, apart from this 15%, they are saying an additional subsidy of 10% on annual revenue expenses for the first 3 years of operation will be credited directly to the bank account only at the end of 5th year, and the same shall not be taxable. What they are saying, the first 3 years recurring expenses, revenue expenses, don't think revenue means sales. That is your expenses that can be debited to your P&L account, revenue expenses. 3 years expenses you take, add it up, on that you apply 10%. This will be what? The amount of subsidy that will be a credit in your bank account, which means this will be treated as an inflow. When? Not in those 3 years, at the end of 5th year. Do not forget that. Clear with this? You tell me, is it anywhere technically challenging? No. But when you are doing the 5th year's cash flow, you should not forget and you should include it properly. That is the only challenge here. Clear with this, guys? Clear with this? Next, the total annual recurring expenses will be 1.8 crores. It includes salaries to managers, staff and employees, utility expenses. They have mentioned everything like housekeeping, security services and all of that. Basically, this is your revenue expenditures, right? And at the end of 10 years, annual recurring expenses will increase at the rate of 10%, which is to be applied once, right? This is what they are saying. At the end of 10 year, what will happen? From 11th to 15th year, what will happen is that, so as compared to this 1.8 crores, from then on it's going to be 1.05, that is 1.1 on 1.8 crores. That will be the annual recurring expenses for the last 5 years. Clear with this? Clear with this? That's all they are saying. Then furthermore, the hotel authority is determined to provide the best and professional hotel services to the clients by offering training to their employees. They decided to spend 5 lakh per year for the purpose of training of their employees. Clear with this, guys? This is one more cost that they are incurring. Now, what will be the impact for this? Can anyone tell me? This is also a revenue expenses. So when you are calculating the subsidy, it is not just on 1.8 crores. It is on 1.85 crores. Clear with this? That is the reason why they have kept it separately. Fine, guys? Yes? Will you guys remember this when we are doing? Yes? Okay, fine. The hotel project will be entitled to enjoy a tax holiday for the first 5 years, after which the corporate tax rate of 25% will also be applied to the hotel. First 5 years, zero tax. Then post that, there's going to be what? A tax rate applicable. The cost of equity for the company is 12%. And the estimated hurdle rate by considering the structure of the capital of the proposed company is fixed at 15. What is this? This is cost of capital. Very good. Okay. So then why have they given this 12%? What is this KE? What should we do with KE? Come on. Quick. Guys, come on, guys. We have to find the rate which is 12%. No. One second, guys. So in capital budgeting, we use a discount factor, discount rate. What is the discount rate? KO. Then you need only 15%. Why do you need 12%? You should ignore it. Guys, this is the issue. 1 plus 1, if it is given in CA exams, we will struggle to answer it as 2 because it has come in a CA exam paper. Here they are testing your knowledge as to whether you are collecting the right data and ignoring the wrong data, right? This needs to be ignored. It's not even relevant. You need to write a note saying that we need to take hurdle rate. Basically means, see, your KO is your cost, correct? Your KO is the cost. So your return should definitely be more than cost. So what you do is, we don't know the return unless until it's actually generated, right? So when we are discounting, we take the cost and we discount and we find out the net present value, and we saying that if I am able to, at least when I'm considering my cost of capital and discounting, if I'm getting a positive NPV, it means that generally the return will be more than my IRR will be more than my discount rate. I can go for the project. That's why a positive NPV will result in an IRR being more than your KO. Correct, guys? Yes, so the required here, the rate is only 15%, right? If you take 12%, everything, operation success, patient dead, denominator wrong means the entire answer is wrong. What is the use of this? Clear with this? That is all they have asked for. Fine, don't think too much. If you know the subject logically, there is no way that it's going to be difficult for you. Now you tell me, guys, that's about it. Depreciation is to be taken on SLM. Thank God, Institute is very kind for you. So, and assume 360 days in a year. Now ignore depreciation on furnitures used in restaurant and conference wedding hall. So basically what they have said is, on these two you ignore your depreciation, right? So depreciation you provide only on building, these two furnitures, elevators and electronic appliances. Clear? Land, obviously it's not depreciable. Clear with this, guys? Clear with this? SLM you use, I think for elevator alone they have given the rate, we can use a direct 5%. Clear with this, guys? Fine. Now what I want you guys to do is, despite the fact that this is an RTP session, it's okay. I want you guys to take 2 minutes time, right? Not to talk. Please read it once, collect all the facts together. Now we will go and do the solution. We will discuss and we will do the solution. Fine. But when we are doing the solution, I want you guys to just keep throwing answers like an arrow, right? Have the figures in your fingertips. Fine. I'm not going to ask you which option A, B, C, D. No. It's going to be a lengthier discussion. We need to do the entire solution. But when we are doing it, at least collate. And one more thing I want you guys to do. Now, predominantly, guys, year-wise is the cash flow changing? Year-wise the cash flow changing? No. So which means you can combine and do for all the years, provided the cash flow is same. Now tell me in this question, will the cash flow be same for all the 15 years? No. Why? After 10th year there will be an increase, but 11th to 15th year it will be the same. Correct? So what you need to do when you are preparing capital budgeting, right, when you are doing this whatever calculation that you have to do, NPV, IRR, initial investment, everything that you are doing, right, what you need to do? So first 10 years, 11th to 15th, correct? Correct? Only two ranges? No. So first 5 years there will be one range. Why? Tax holiday is there. Clear? Just imagine you did first 10 years, 11th to 15th, halfway through you realize the mistake. Can you come back and redo the entire question? Then this is the only question you will be able to do in the entire 3 hours. This is the reason I'm saying be very observant. Okay, 3 ranges are there. First to 5, 6 to 10, 11 to 15. Clear with this? Guys, clear with this? These are little observation skills that you need to definitely develop when you're reading the question. Collect the facts with you. 2 solid minutes I'll give you. Give your everything. Right? This is generally that I tell in the regular lectures also. Assume this question has come in your exam hall. You're sitting in an exam room right now. Right? So it is something like, assume you don't know how to swim and someone is throwing you inside the ocean. What will you do? You'll say like, I don't know how to swim, I give up, let me die. Or you'll do something to grasp for breath. You'll do something, right? Bring that survival instinct right now. You are put in that exam situation and assume there's no one to help you. What will you do? That survival instinct should come and I'm sure you will be able to crack it. Fine guys, 2 minutes, come on, let's make it. that we can do separately, that we can add it separately and do. Adukkaha again building another range will be more difficult. Yes, at the end of 12th year, as you are saying, there's some 18.725 lakhs. There will be some outflow separately. You are right. That we will do separately. See, one-off items we will do separately. If something is applicable for more than 1 year, then we will build a range. Then in that case, then we need to keep building multiple ranges. One-off items we will do it separately. Yeah, we will consider that. Good point. Come on, guys, quick digest the facts and let's move on. This is one sum that is going to take some time. Beyond that, every other sum it's going to be relatively lesser time. At least you jot down like whatever I did from that paragraph, whatever that you need to have, the data you put it on your fingertips. When we are doing something, you need to be able to answer that. Come on, quick. Yeah, 30 more seconds. Done, guys. Shall we start? Okay, fine, let's get started. Now I'm not asking you to do the entire solution. I just wanted to read the question once. That's all. You can't do the entire solution in 2-3 minutes and all. Okay, come on, guys, actively participate, right? Actively participate. Okay, so now come on, let's get started. Now first, what are they asking for in the first component? They are asking you for the net initial investment. Right? But remember in this question, there is no one outflow. At the end of 10th year, again, some furnitures need to be repurchased, 15% extra cost and all, right? That is also there, but here they've asked for the net initial investment, right? So shall we get started? Yes. So first, what have they said? The cost of land and the construction cost they are asking for, right? So cost of land and construction cost, it's already given. 250 million plus 100 million is going to be 350 million or nothing but 35 crores. Clear? Any issues here? No. Then furniture cost, we calculated, right? Have the question in front of you, right? Have the question with you. So we saw that 40 normal rooms and each normal room required 1.5 lakhs. So how much is that? 60 lakh rupees. So for deluxe suite rooms, there are 8 suite rooms and you've got 3.8 lakhs per room. That's going to be 30 lakh 40,000. Guys, correct? Yes. Right? And remember, these two alone needs to be, they alone need to be depreciated, and that is there. And at the end of 10th year, it has some salvage value and all, and it needs to be replaced. The replace cost is going to be 15% more and all that. Remember that. Just have it with you. Now it's not relevant. Then conference and wedding halls, 2 into 7 lakh, right? That's going to be 40. And you've got for restaurant, it's going to be 10 lakh. Guys, these figures we were able to pick it. Yes. Then elevators, 4 into 35, that's going to be 140 lakhs. Electronic appliances, it's given, no? It's directly given. It's given as 35 million. 35 million is nothing but, so put one decimal before, it will be converted into crore. 35 is going to be 3.5 crores. That's all. Clear with this? Fine. So if you add up all this, and yeah, that's about it. If you add these figures, are you getting this? 41 crore 4 lakh and 40,000. Right? You will get this. Definitely, there's no mistake and all that. I checked it. Okay, fine. Now on this, don't forget, there is a government subsidy, right? Government says that we will fund to the extent of 15%. We are not bothered about how government is funding us. Yes, so this is not a cost for us, and it will be given today or 3 years later. This will be given today when it is incurred. Very good. Cost incurred. We read that, right? Very good. So 15% on that you reduce. The net initial investment is going to be how much? 34 crores, 88 lakhs and 74,000, right? So whichever option that is, it's going to be option number B. So this is what it is. Clear with this, guys? Fine. This is fairly simple. 2 marks. Yes, this is fairly worth for 2 marks. We can accept that. Going forward, NPV and all, the calculation is going to be a little big. Fine. Let's do that. Now, guys. Now, So first, let's directly jump into this. Look at the note that they have given for discount rate. Discounting rate would be the hurdle rate and not the cost of equity, as hurdle rate means the overall cost of capital. So which means they are testing you as to whether you have the ability and the knowledge to ignore KE as the discount rate. Look at how institute is testing, right? This is where conceptual learning comes into play. You can't mug up. Fine, right. But anyways, all these notes are not a part of MCQ, but I'm saying this question can also come in your descriptive if it comes, or maybe they are they are maybe not making this big, but they are using these concepts and framing one descriptive question. It is possible. Clear with this? So you should know that it needs to be ignored. So now first what we are doing is, okay, so first we are calculating the present value of cash outflows, because the second question is about calculating the NPV. How do you calculate the NPV? Simple, present value of cash inflow minus present value of cash outflow. So we are not bothered about profits and all. Cash flow is the criteria for us. Clear with this? Will depreciation be considered? Depreciation will be considered for the purpose of taxation, right? So you subtract, arrive at the tax, add it back. Clear with this? So net off, it nullifies, but its presence will give you a tax shield. For that purpose alone, it will be considered. Clear with this, guys, right? You guys are aware of that. Now, so initial investment, this figure, we got it. We already got it, right? 4 crore 88 lakh 74,000, we already got it. Discount factor is going to be 1. It's happening at 0, year 0. Beginning of year 1 is year 0. Correct? Today it's happening. It's already in present value. Correct? Okay, fine. So now next here at the end of 10th year, so they have said something. They have said that it's going to be purchased. They are going to purchase some new furnitures, guys. Yes, new furnitures. Now what you can do is we have these two figures here, 60 lakh and 30 lakh 40,000. Correct? Just add a 15% to that. So 1.15 into 60 lakhs. How much is that? Hello? How much is it, guys? 69 lakhs. Correct? 69 lakh. So this is going to be the purchase of furnitures, right? I need to bring this money in. Similarly, 1.15 into for suite rooms. How much is that? 30.4 lakhs. How much is that, guys? 34 lakh 96,000. So these are the cash flows at the end of what? Cash flows at the end of 10th year, right? Cash flows at the end of 10th year. Fine. Then at the end of 12th year, there was one renovation also. 18.25 lakh breakup, 20 lakh minus 1.75. That 1.75 is not salvage, it is scrap. Clear? It is scrap. Okay, that's why we are netting it off and we are putting it here. Clear with this, guys? But all these rooms, it had a salvage value that we will consider separately. Guys, are you clear with this? Are you clear with this? Right? Because salvage value will not be considered at the time of putting the money in. Right? That will be treated as a separate inflow separately. Whereas this one, they are using some materials out of which there is some scrap. So net off, then and there itself you can put it. Clear with this? That is the difference between scrap and salvage. Okay, guys, you guys are clear with this? Fine. This they have done, discounted, arrive at the value. Next, the main thing comes with respect to arriving at the cash inflows. Right? This is where the main issue arises. The first thing that you need to observe is there is a set of 3 years, right? Apart from that salvage values and that purchase and all someone was saying, these things are incurred in some additional years that we will be doing separately, right? But if there is a trend for more than 1 year, we build a range. If not, we can consider it separately later on. That can be done. Clear with this? This is for ease of calculation. Or there is also an alternate way. If you want, if you have all the time, year 1, year 2, year 3, year 4, you do it repeatedly. That will also come, you will get the right answer, but after 4 hours of the exam time. Okay, so you need to borrow 1 hour of your personal time also to do that. Okay, fine. Coming back, guys. So now first thing, let's arrive at the sales figures. Sales figures, how do you arrive? I told you this is directly given here. All you need to do is to just multiply. Try it for one figure, the remaining figures are the same. So do it 40 into 120 into 8,000. How much is it? 3 crore 84 lakhs. Clear with this? Similarly for the other 3 also. Clear with this, guys? Yes. Year 1 to 5. Will it change in year 6 to 10? No, because only after the 10th year the growth rate is happening. Then why do we have this breakup? That's for the tax impact. Clear with this? Tax rate, holiday, first 5 years. Right. So here what will happen? So here also it's going to be the same. Here alone it will change. You apply the respective rates. For normal room alone we will do and see 12% increase. So now 3.84 crores into 1.12. How much is it? 4 crore 30 lakh and 8,000. Is it coming? Yes, guys. Similar calculation is being done here. Similar calculation, I don't want to waste the time in doing it. Similar calculation is being done here. Are you all comfortable with the figures? Yes, guys, yes. So the sales figures are sorted now. Next, what have they said? Annual recurring expenses. Where is it given? Where is it given? They have mentioned it here. Annual recurring expenses is 1 crore 80 lakhs. Done. So 1 crore 80 lakhs they have done, and after the end of 10 years it's going to increase the rate of 10%, right? So now for the first 10 years, 1 to 5, 6 to 10, it's going to be 180 lakhs, right? Then 1.1 into 180, how much is that? 1.98. Clear with this? Yes, this line item is sorted again. Done. This is excluding depreciation. These are like cash expenses, they are incurring it. Fine. Then you have some training expense also, which they have mentioned as 5 lakh per year, right? 5 lakh per year. So 5, 5 and 5. This they have not mentioned any growth rate or increase in all. Clear with this, guys, right? Next. Now comes depreciation. Now depreciation, how do you do it? First, for building, what have they said? This is where collecting these figures and putting it here in an easy to understand way. If you want, you can take a rough sheet in the exam, I'm saying, and do it, right? So I would in fact insist that you do it, or it's recommended that you do it, because again you can't go back to the paragraph and read it, it's a waste of time. Now what happens? 100 million is basically 10 crores, right? 10 crore is there, rate is not given, they have given SLM, correct? So 10 crore is the cost of the construction cost basically for building. Out of that, 25% is the salvage value. So which means net of this, 75% of 10 crores needs to be depreciated over a period of 15 years, which means 7.5 crores divided by 15. How much is that? 50 lakh. This will not change. 5 lakhs, huh? 50 lakhs. Okay. So 50 lakhs. Yes, this will not change. There is no growth and all that here. Elevators. What do you do for elevators? They have given 5%. 5% on 1.4 crore. How much is that? Calculate, guys. Calculate. Tell me. How much is that? 7 lakhs. Yes, this figure will also not change. Electronic appliances. They have mentioned something about electronic appliances. So electronic appliances, how much is that? 35 million, right? So that's going to be 3.5 crores. Out of that, you have a salvage value of 15%, right? So 3.5 crores into 0.85. Basically, that is the overall depreciable value. For a period of 15 years, how much you get? 1 lakh, 19,83,333. Guys, are you all getting it? These calculations are not mentioned in the RTP, but I want you guys to understand how these are coming. Fine, clear with this. That's the reason we are doing this discussion here. Clear? Yes. Now, old furniture. Look at this, old furniture. What they have mentioned, the depreciation is applicable only on what? Only on these two components. Guys, correct? That is on normal rooms and your deluxe suites. Fine. So how much is that? Basically, this cost you've got here, we got in this initial outflow itself. How much is that? So 60 lakhs plus 30 lakh 40,000. That's basically 90 lakh 40,000. So this is the amount that you need to depreciate. Correct? Yes. Okay. Now what have they said? They have said that it will be having a salvage value of 5%, which means net of that 95% should be depreciated. Correct, guys? Over a period of 10 years. Guys, yes. So tell me how much is that coming out to? So 90 lakh 40,000 into salvage value is 5%, no? 0.95 divided by 10 is going to be 858, 800. Is it matching? Yes. So this is only for 10 years. Correct? Now from the 11th year onwards, what is happening? So new furnitures are coming in, right? So for those new furnitures, what have they given? Have they given any salvage value? Guys, for the new furnitures, what have they mentioned? So it's going to be 5% increase. Okay. So what is the new cost? So I think we have, yes, this is the figure, right? This is the figure that we've got. Guys, this is the amount that we are actually spending for purchasing these new furnitures. Guys, yes. So it's going to be how much? 69 lakhs plus 34 lakh 96,000. How much is that? 1 crore 3 lakh 96,000, right? So that divided by 10 years, is that what they have also done? Yes, sorry? That is having considered 15% increase only, no? Look, I took this figure at the end of 10 year after considering this 15% increase. At the end of 10th year, I have purchased this. It will have a life of 10 more years, right? Here they have not mentioned anything about the salvage value of the newly purchased furniture at the end of 10th year, correct? So which means you need to depreciate it for a period of next 10 years, starting from the 11th year. Guys, correct? Yes, correct. So that's where they said old furniture purchase is fully written off. That depreciation will not be there in the 11th year. For the 11th year, when it comes to furniture, only the asset, only the furniture that got purchased right now, this figure will be amortized over the period of next 10 years, right? But again, the life of the project is 15 years, so maybe you will stop doing it at the end of the 5 years from now, but that is different. But when it comes to depreciation policy, you should follow that. So divided by 10, are you clear with this figure, guys? Add it up, divided by 10, you will get this figure of 10,39,600. Guys, are you clear with this? Yes? Yes, fine. So you get all these expenses, you can just add it up, you'll get the total. These are the expenses. And why are we doing all this depreciation? Because it has a tax impact. Maybe not for the first 5 years, but later on it has. Okay, so your net profit before tax is basically your sales minus your total expenses. Let's not do the calculation right now. It's basically the same, right? And what will be your tax amount? For the first 5 years, it's going to be nil. Then the tax rate is given in the question, right? How much is this? 25%. So 25% they have applied here. So it's at the rate of 25%. You get these figures. Clear with this, guys? So you get what? Your net profit after tax, right? With this, you add back your depreciation. You add back your depreciation. That is nothing but a sum total of what you got here. Clear with this? You add it back. Ideally, this has to be a subtotal. Sorry. Yeah, ideally, this has to be a subtotal. This is not plus. This has to be a subtotal, right? So this is going to be the figure. Are you clear with this, guys? Are you clear with this? But remember one thing, this is for per year, per annum, correct? No, this is per annum only, no? Yes, correct? So this is for a period of, for each of the first 5 years, this is going to be my cash flow. Then for the next, each of the 5 years, this is going to be our annual cash inflow. Then for the last leg of each of the 5 years, this is going to be a cash inflow, correct? Right? So when we are doing this, what we need to do? So here the present value factors, basically the present value factors, what do you do? You guys know how to prepare this present value table, right? So present value factors for 15%. So even if it's not given in the question, here they have not given, you can do it, right? 1 divided by 1.15 is equal to, and you can put it, right? So just tell me, guys, I'm just quickly doing it. Okay, so for the first 5 years we will do. So 1 divided by 1.15 is equal to, how much is that? 0.869. Then for the second year, 756. Then 657. Then 571. Then 0.497 something. Okay, fine. So basically what we are doing, hello, please, coming back. So see, I'm telling, it might be basic, but there might be some students who might not understand. That's why I want to make it clear for everyone. So basically this same figure you are going to multiply with 0.869 for the first year, then you're going to multiply with 0.756 for the second year, and so on. So what we are doing for the first 5 years, since we are multiplying this with a common figure, we are adding up and we are putting it here. So basically the present value table for 5 years, year 1 to 5, we are adding it here. Similarly for year 6 to 10, we are adding and putting it here. Similarly for 11 to 15, we are adding and putting it here, because we need to finally arrive at the present value of cash inflows. Are you clear with this? But remember, here we have only considered the recurring cash inflows, right? There are also some salvage values and all these things that are yet to be considered, which we will be doing separately. Are you clear with this, guys? Right? If you do that, so we have arrived at, for the first set of 5 years, this is the total present value of cash inflow. Second set of 5 years, this is the present value of cash inflows. And for the last leg of 5 years, this is going to be your cash inflow. Clear with this, guys? Apart from that, in year 5, there was a government subsidy, right? On what? 10% on your annual expenses, right? So what is your annual expenses? 1 crore 85 lakhs. This should also be included, correct? Correct? Yes. How many of you forgot this? Genuinely accept. This is what I'm saying. I told you, in fact, right? So I'm not saying this to pinpoint you. Just imagine. This is like, this is how the human brain works. When you're given a lot of data, you tend to miss out on certain things, right? Have we discussed any high level concept here? No. But the figures and data given here is absolutely messy, right? and if you are able to organize it in a certain way and do it within a given time frame, then that's where you tend to crack the exam. Clear? That is all they are testing. There is no high-tech concept involved here. Clear with this, guys? They have given a lot of data just to make your life miserable. That's all. Okay, fine. Coming back here, so it's going to be, come on, calculate, guys. It's going to be 1 crore 85 lakhs. On that 0.1, how much is it? 18 lakh 15,000. 18 lakh 50,000. Guys, correct? Into 3 years of expenses they will give. How much is this? 55 lakh 50,000. Correct? So they are saying they will pay you 55 lakh 50,000 credited to your bank account. When? At the end of 5th year. So the 5th year's whatever is the present value table, they have multiplied it and they have arrived at the present value of this 55 lakh 50,000. Directly they have arrived. Clear with this, guys? Any problem here? No. Then there is one more thing. There is one more thing mentioned here. So this is actually annual revenue. This is off annual revenue expenses. This is one point. Then in the 10th year, you have the salvage value, the old furniture, no? That 5%, what was the salvage value? 5% only. Guys, correct? So that is an inflow right now. Guys, correct, guys? Yes. Fine. Don't give up easily. Please don't give up. You can definitely do it. So please have that patience, have the perseverance, right? This is equally, when so much of data is given, whether a faculty or a student, everyone tends to get confused, and you should not give up. That's the only thing. That's the only thing I'm asking you right now. And before I started, I told you this, don't carry this whatever feeling that you get out of this sum to the next sums, because the next sums will not be like this. This one question, they have treated as a separate animal. It's like a zombie only. It's here to destroy, but we should be fully prepped up for it. Okay, guys, coming back. So this is one inflow that you will be getting, that is basically your salvage value. Fine, right? That has also been multiplied with the present value factor and you've arrived at it. Then finally at the end of 15th year, you have this building and your electronic appliances. Correct? Building and electronic appliances. On that also you will be having a salvage value, right? So if you look at this, building has a salvage value of how much, guys? 25% on 100 millions. That's going to be 2.5 CR, 2.5 crores, right? And your electronic appliances, 15% on 35 million, 3.5 crores, 15%. How much is that? Into 0.15. So 52 lakh 50,000. So 52 lakh 50,000 plus 2.5 crores. How much is it? 3 crores, 2 lakh and 50,000. Clear with this? This breakup is not given. This breakup is not given. What, you're packing your bag? You want to leave notes, huh? Illa. I was asking, like, is it so boring and all that? Please, guys, just I can equally understand. It's like kind of it will go above your head at times. Have the patience. Step back a bit. It will be like that. Okay, that's why I gave you the disclaimer right at the beginning. Okay, coming back. I know that you didn't mean that way. Okay. Coming back, guys, so it's going to be 3 crore 2 lakh and 50,000 into whatever is the present value table. You arrive at this figure. So now you get your total present value of cash inflows. Guys, clear with this? Clear with this? So now you have your total cash inflows. So how you arrived at this figure? This plus this, then plus this figure and this figure also. Clear? If you add these 5 figures, is there a highlighter here? Oh, it's an eraser, is it? Okay. Already things are erased off. So these 5 figures, 1, 2, 3, 4, 5 and 6. Clear? Fine. If you add it up, you get this figures. Okay, guys. Okay, fine. So this is going to be your total present value of cash inflows. So now what they have done is on the top. So present value of cash inflow, this figure, whatever we got right now that they have mentioned. Present value of cash outflow, 35.1785. This is the figure that you got here. Okay, and finally you get what? Your NPV as 7.0532 CR. So successfully 2 marks credited to your account. Okay, so for all the little efforts that you put, 2 marks. And the pitavagala solvangala unga mana dhairiyatha paarati andha madri. So how much is that? Which option? A va? Okay, A. Okay, guys. So pray God that this should not come as a 2-mark question. If this comes as a 10-mark question, then at least it's worth all the time. Ideally, it should have stopped here, but they're asking for payback and all these things. But guys, clear with this. Now you tell me, was there anything super technical in this question? No, it is just about your observation skills. It's just about your observation skill, and just a little more and we'll finish off the sum, and then like every sum will be from different concepts, so that will at least be a little more interesting. But I know the interest level with which you started right now might not be there. I have to keep telling this to you again and again, because don't carry forward all these things to the next questions. Okay, then payback period, guys, coming back now, these are like at least relatively easier. Payback period, what do you mean by a payback period? So the time it takes for you to recover your initial investment, right? Initial investment. I can see someone is talking, please. Yeah, so the time it takes for you to recover back your initial investment. Why am I stressing so much on the word initial investment? Because there is an investment being done at the end of 10th year also. That does not come in your payback. Clear with this? And payback period, does it consider your time value of money? No. Discounted payback period only considers. Very good. Fine. So now how do you do it? I think it's fairly a simple calculation that many of you might have known already. So they've given, okay, so what was the initial investment amount? It's going to be 74,000, okay, right? So basically this is the amount that is there. Now what they have done is, now it is not discounted for cash inflows. So where do they get these figures from? These figures you would have got it from this step, right, before discounting itself. 7 crores 76 lakh 20,000 is the amount of profit that you get in each of the 5 years. But wait, at the end of 5 years some government subsidy is also coming in. Guys, clear with this, right? No matter where you go, institute will be after you. So they could have kept it at the end of 6th year, no? So if you did it, then maybe if that is done, so maybe even if you ignore, your payback period will be correct. Guys, clear? So here also they didn't want to miss out on an opportunity. They are figuring out everywhere. So what you do basically is that you just keep on accumulating it. So when do I recover? I need to recover 34.88 crores approximately. So at the end of 4th year, I would have recovered 31.04 crores. And at the end of 5th year, I would have recovered 39 and odd crores. I just want to recover 38 point some crores. So basically you can understand that it lies somewhere between 4th to 5th year. So the 5th year's cash flow, basically whatever that is, the difference between the two, if that is for 12 months, how much is it proportionately, you will calculate and you will arrive at this figure of 4.46. The calculation is as follows: 4 plus whatever amount that you have to recover, that is basically 34 crore 88 lakh 74,000 minus 31 crore 4 lakh and 80,000. This is the amount that I have to recover, right? However, for me, in a year I am able to generate, in the 5th year I am able to generate 8.31 odd crores. So basically proportionately how long it will take for me in that year to recover. This is the calculation. Clear with this, guys? Are you all clear with this, or you need any explanation here? Right? Done? Fine. So this is how they've got this 4.46, and this is also done. But again, remember, this requires, putting a table and solving it in an exam. That's again time consuming. It may be easy in concept, but it's again time consuming. I do agree with you on that. That's why I'm saying this is definitely not a 10-mark question. Like basically whatever, 5 into 2, right? 10 mark, definitely I don't think this question is worth much more than 10 marks, especially for all the data, as well as a lot of irrelevant data. Like first 2 paragraphs you read only to find out that it's nowhere related to the question. He's a doctor, but he's moonlighting and he's okay, fine. So next one. Coming back, guys, here estimated recurring accounting profit and loss for the first 3 years. Guys, so for the first 3 years, what was the accounting profit? So what you can do is basically here you look at this. First 3 years accounting profit, what is it? Okay, so for the first 3 years, it is going to be, see, this is accounting profit they have asked for. Accounting profit, right? It's accounting profit. Here in your in your capital budgeting, you talk about cash flows, right? But what happens here is, ideally the 3 years of subsidy should have ideally been accounted in each of these 3 years, but it accrues in those 3 years, but the receipt is only happening in 5th year. In FM, we just go based on cash flows. We don't go based on your accrual concept. Whereas when they are asking you for the profit, recurring profit, so that needs to be considered in the respective year. So what you need to do is pick this figure and add back whatever subsidy. Why add back? Because basically it results in a reduction of expense. Correct? Reduction of expense is going to be an increase in your profit. Guys, clear with this, right? Fine. Or you can even say it's going to be like what? Your AS12, no? Yes, 12 grants, government grants. Yes, so that is how it is anyways. So 6.90 something, the figure that we got, plus every year it's going to be 1.8 crores plus 5 lakhs training expenses. Remember that training expenses has an impact on all the three, right? Whatever thing that we have done till now, maybe not on the first one, it has impact everywhere. That 5 lakhs, if you miss out, it's gone, right? They would have made one option, ABC, one option would have been made without considering, it's waiting for you. You will also come out of the exam hall with full satisfaction, argue with your friend that I got it right, only to realize that, no, let me not jinx it. Okay guys, fine. So this is going to be the answer. Fine guys. Yes, clear with this, clear with this. So here for accounting profit, there's only one adjustment, you need to add back the government subsidy. Clear? Guys, yes, right. Finally, oh fine, IRR. Okay, so IRR, basically guys, IRR, I'm telling you this, they should have at least given you, because when you are taking 15%, you're getting an NPV of how much? You're getting basically a positive NPV, no? Guys, 7.05 crores, correct? So let's assume that you have to calculate the IRR right now. It's not assumption, it needs to be done. Okay, so now what you will do is, you will take another trial. IRR is basically done trial. Is there a formula for calculating IRR? There's no formula for calculating IRR. Now don't tell me that accounting rate of return 1 by, that is all some, an approximation only. IRR cannot be, exactly computed. You only need to use trial and error. Do you know that based on the trials you use, the answer will change? 15-20, 15-30, more the spread, more the inaccuracy. You need to keep it lesser, but anyways, all of that apart. So right now, so when I am keeping 15% as the discount rate, I am having a positive NPV. So now, what should you take as the next trial? The next trial should be more or less? More. Why? Simple logic, discount rate comes in the denominator, right? IRR is a rate at which my NPV becomes 0. Only if I increase the denominator, it will reduce from positive to it will at least become 0. Correct? So next trial should be that. It should be what? It should be higher. So they have taken it as 20 and they have done the interpolation, but that again is a different 10 mark question, or at least 5 or 6 marks, but this is what they have done. Look at this. So at 15% it is so and so, and at 20% they have arrived at it, and then they have done this interpolation and they have arrived at it. This interpolation you guys know, no? Yes. Right? They have done it, they have arrived at it, but definitely I think, see, asking an IRR for 2 marks is good, provided they give you this. They need not give you at 15%. They could have given you 10% so much, 20% so much, the value at least if they give, maybe they could have tested as to whether you're picking 20 and 15 as the interpolation base. That alone they could have done, but anyways, I think if it comes in an exam, it will come like that only, or it could come in a descriptive, but definitely for a full, this itself is going to be like a lengthy calculation, because once again you need to redo everything with 20% base, and that's not kind of a very good thing to do for a 2 mark question. But anyways guys, that is about this question. You guys are at least clear with what is done here. Now the main thing that happens in an exam hall is, I can understand when you look at this bigger question, it breaks your confidence, and trust me, that is the main reason why it is being kept. So what will you do in the exam hall? If I were you, I'm just giving my opinion. The moment I read this question, it's not that I cannot do it. I would reserve it in the end. I will not touch it right now. You can just go through the question, you will know. Few seconds into it, you will know whether this question is going to be lengthy or not, right? So what I will do is, sir, it's a compulsory question. Yes. For that sake, what will you do? You will spend the entire 3 hours for this one question, is it? Because the moment you start doing it, what will happen is, maybe you will take some more time. Maybe let's say you're taking about 45 minutes. That's a huge for a 10 mark question. Taking 45 minutes only to realize that you're getting stuck, you're not going anywhere. Now assume you finish the entire, all of that, you're jumping now to the next question, doing all the questions. Even if you come back, you will only have to start from the scratch, because you won't even know from where you left. That is the problem about this question, no? Reserve it to the end. Please reserve it to the end, because you will never know how time flies. When you touch questions like these, you will never know. In an exam hall, especially in subjects like costing and FM, first do the questions that you are very clear about, and it is also relatively lesser time consuming. Do it, score it well. Then you have all the time. With that, whatever time is left off, you can actually focus on the remaining problems. Clear with this, guys? Follow this in an exam hall. It's a hack, because simple, have one thing in your mind. All of us are normal human beings. Teachers too, I'm saying even me, everyone. So we can't do certain things beyond a point, right? So if you find it difficult, the entire student fraternity is also going to feel the same way, right? And don't worry, institute cannot fail everyone. Correct? Correct? Have that in your mind. Have that confidence in your mind when you are doing it, right? Okay, so what if this question is coming, I'll move, because some people have this mental block that if there is a compulsory question, I need to first definitely attend it. I can understand you need to definitely attend it, but what is the objective? Scoring a minimum of 40 marks, on an average it should be 50 in a group, correct? Make that your point irrespective of where the marks come from. Compulsory, if you find it difficult, do it towards the end. I'm not asking you to omit it, reserve it to the end. At least the other areas you can focus on. Clear with this, guys? Clear with this? And by the way, you guys are aware, from this attempt onwards, you are allowed to take your MCQ booklets, right? So a big relief, huh? Nothing of that sort. It should have been done in the previous attempt itself. But anyways, it was already done in the previous attempt, huh? Okay, fine. Whatever, guys. Whatever, guys. But anyways, now you can officially bring it off. But anyways, good. Institute has at least made sure that you can take it, you can take it back home, maybe for practice and all that. But let's pray God that you. No, I was about to say, wait. Practice for your juniors, not for you. You should finish this exam in this attempt only. Fine, guys. Let's go back to our library of adjustments and close it off. Come on, do it. What do you want to practice again, huh? Okay, fine. Write down. Guys, question number one. The type is going to be what? CB. Yes, CB, case study based MCQ. CB or CSB, whatever it is. See, it should, you should be able to recollect what it is. That's all. You can put it in your own words. Case study based MCQ. Chapter is investment decisions or capital budgeting, whichever way you want, you can mention it. And write down. Please write down. Initial investment, semicolon, NPV, semicolon. Initial investment, semicolon, NPV, semicolon. PBP, basically a payback period. PBP, semicolon, accounting profit, semicolon, IRR. Initial investment, NPV, payback period, accounting profit, IRR. Yes, and any other specific things that you guys found challenging? Come on, quickly tell me. Huh? Scrap value, write down. Scrap value calculation. Yes, because it was different for different types of assets. Yes. Write down. Semicolon, ignore KE. Write down. You write it like this directly. You will know that. Ignore KE. That was, if it was a descriptive question, that would have carried 1 mark. I'm sure it would have carried 1 mark. The fact that you were writing itself would have, it would have carried 1 mark, or at least half a mark, whatever it is. Half a mark, don't think they will not allow it. Exam paper, when they are correcting, they even have quarter marks when they are correcting it. Overall, they will add and round off. But the answer paper, exam scheme, as they call it, answer scheme that they have, the examiner will have quarter marks stepwise, right? Overall, they will add up. Okay, fine. Then what else? Subsidy calculation, write down. In that training expense, within bracket training expense to be included. Guys, whatever you found challenging, you write it down. Then anything else?
Because of tax holiday, there are 3 ranges.
Right. The first thing, building 3 ranges. Write that down. 3 ranges of cash flows. 0 to 5, 6 to 10, and 11 to 15. Done. Fine. Yes. Fine, guys. Right. Now, shall we move on to the next question? Let's move on to the next one. Okay, so this is from the chapter ratio analysis, a direct question. KT Limited's opening stock was 2,50,000. Guys, come back, please come back. See, one reading, right? Bring all the observation skills, start doing it and get the answer. That's all. Let's move forward. The remaining sums are not that lengthy, right? Some challenges are there here and there that we will discuss anyways. Okay, quick, guys, quick. This is nothing in front of the sum that we did. Opening stock 250, closing stock 375. Sales during the year was 13 lakhs. The gross profit ratio was 25% on sales. The average accounts payable are 80,000 rupees. What is going to be my creditors turnover ratio? What's my creditors turnover ratio? Okay, so how do you calculate creditors turnover ratio? Credit purchases divided by average accounts payable or average creditors basically. Yes, fine. So now average creditors is how much? 80,000 given in the question. Guys, correct. What's going to be the numerator? How do you arrive? Okay, so you need to calculate COGS, is it? Okay, so how do you calculate COGS? Sales is given as 13 lakhs. Gross profit ratio is given as 25%. 75% on my sales is going to be my cost. Correct? How much is that? 9,75,000. Okay. So basically, once again. Now, what you need to do is you need to calculate purchases. Correct? Now, guys, in this question, you might have one doubt. Okay, if you don't, then I will create the doubt. Okay. So what the doubt should have been is, so we are talking about basically purchases. What do you purchase? Raw material or FG? You will purchase raw material, correct? They have given stocks and on the sales and all they have given. How will it come here? Nothing is mentioned here about raw material FG. Maybe this could also be a trading concern, no? They are just in the business of purchasing and selling it. They don't manufacture, correct? So how will you arrive at your purchases figure? Opening stock, right? Plus purchases. This will be the total goods available. Maybe a part of it would have been sold. So only the cost of sales you should take, cost of goods sold. And it is represented by COGS plus closing stock, correct? Opening stock is how much? 2.5 lakhs. Closing stock is how much? 3.75 lakhs. Sales is 13 lakhs, but you can't take the sales here. Only the cost of sales or cost of goods sold should be taken. 13 lakhs into how much? Into 0.75. How much is that? 9.75 lakhs. If you do this, you get the balancing figure. How much is that? 11 lakhs, right? So you put it as 11 lakhs here upon 80,000. How much is it? 13.75. Clear with this, guys? So basically, what does this creditors turnover ratio stand for? How many number of times you make the payment to that creditor in a year? Are you clear with this? So in a year, I make payment to him 13.75 times, right? Fine. Or if you say 365 days divided by 13.75 times, so what is the credit period that is given you will be arriving at? Are you clear with this? You can play around with this. Fine, guys, that's about it. Very straightforward, a vanilla sum. Just go and update your library of adjustments. Write down. It's a standalone MCQ, single MCQ, whatever it is you want to write, direct MCQ, standalone basically. Then chapter is ratio analysis. And under the concept, write down creditors turnover ratio and semicolon, creditors turnover ratio, semicolon, calculation of annual purchases. Calculation of annual purchases. Calculation of annual purchases. Done? Done, guys? Yes. Now let's move to the next one. This is from the chapter leverages. Right? Now let me just quickly read the question and then whatever is the background required, I'll give it to you. Superb question based on, I mean, it's not a very difficult question, but if you've learned the subject conceptually, 100% you'll be able to crack, but by just looking at the question, you'll be able to answer it, but provided it is learned conceptually. I think we covered a similar question, or in fact, a very, very similar question. We covered it in our regular lectures. But anyways, coming back here, please guys, again, bring full focus. I will give you a background and I will do it. Now, a firm has a sales of 75 lakhs, a variable cost is 42 lakhs, and the fixed cost is going to be 6 lakh rupees, right? Next, it has a debt of 45 lakh at 9%, which is basically your interest rate, the coupon rate, and equity of 55 lakh. Does it have a favorable financial leverage? This is all they have asked. Now, first guys, tell me, what do you mean by a leverage? What do you mean by a leverage? So, getting more results by putting in small efforts, or in other words, getting a magnifying effect is called as leverage. So, chinna kallu pedda labam. That is actually the meaning of leverage, right? Now, how do we get that basically? Is leverage good or bad? It's a double-edged sword. It's mentioned in your study material. Leverage is a double-edged sword. If I say, for example, operating leverage is 2 times. What is the meaning of that? Operating leverage is basically, it captures the relationship between your sales and EBIT. It is nothing but percentage change in EBIT divided by percentage change in sales. If, for example, I am saying operating leverage is 2 times, it means if my sales increases by 10%, it's all percentage, it's not an absolute numbers, right? My EBIT will increase by twice of 10%, 20%, correct? Yes? But if my sales fall by 10%, my EBIT will fall by 20%. So when you are in a growth stage, leverage will be in your favor. When you are in a decline stage, that same leverage will act against you. That's why it's a double-edged sword, right? A sword is sharp generally on one side. If it is also sharp on your side, if your enemy comes and pushes it back to you, it will kill you, right? That's why they say it can be used to defend you at the same time, it can also kill yourself. That's why you need to play very strong, very carefully with leverage. But why does this leverage effect happen? Why does? It is because of the presence of fixed cost. Operating leverage happens because of the presence of fixed operating cost, whereas your financial leverage happens because of the presence of fixed financial cost. What is fixed financial cost? Only 2 things. 2 things are there. Interest and preference dividend. Taxes? No. Why? Because it's not a source of finance. It is an obligation that you're paying to government. Is tax fixed or variable? Neither. It is neither fixed nor variable. Is it? Okay, if your sale increases, proportionately your tax will increase. Huh? So yes, it's neither fixed nor variable. It's a separate thing altogether. Clear with this, guys? Clear with this? Fine. These are some basics of leverage that I just wanted to brush upon. Now coming back here. Now they have given this data. This is based on a concept called as trading on equity. This is based on a concept called as trading on equity. I don't know how many of you actually figured this out, that it's based on trading on equity. Okay, fine. It's okay, fine. Trading on equity, that is what this concept is about. What are they saying? Now guys, let us do this. They have mentioned that there is a sales of 75 lakhs, correct? Variable cost is 42 lakhs, correct? So what's going to be your contribution? 33 lakhs. From that, there's a fixed operating cost of how much, guys? 6 lakhs. So how much is going to be your EBIT is going to be 27 lakhs, correct? Done. Now you tell me here, this 27 lakhs here is there. This is the operating profit. Did we even touch any financial item? No. This is the profit reported by our friend costing, the other subject, right? Now, what was the total capital employed in this company? 45 plus 55, debt plus equity, 100 lakhs or 1 crore, right? So tell me, what is the return on investment? 27 lakh is the operating profit that you get before paying any of these the sources of finance. You generate how much? 27 lakhs for an investment made of how much? 1 crore. Basically your return on investment is how much? Correct. Now let's continue this. From this, what will I do? Interest I will be paying, correct? How much is it? 9% on 45 lakhs. How much is that? 4,05,000, no? Okay, so 405,000. Okay, so finally there's no preference and all that here. So you have any taxes? No. Okay, so this is going to be your earnings before tax, also your earnings after tax. No preference, so it's earnings available for equity shareholders, everything. Finally, how much is this figure, guys? 22,95,000. Right? Now you just tell me, this amount fully belongs to whom? Equity shareholders. Do they need to share it with anyone else? No. Right? Of course, a portion of it may be paid, or balance retained earnings. That is fine. That is dividend decisions. Now, coming back here. Now, how much was the amount of equity investment? Equity shareholders invested how much? 55 lakhs. But they are getting how much? 22.95 lakhs. Correct? So, you tell me what is the return that the equity shareholders are getting? Return on equity. How much is that? 41.727% approximately, right? Guys, I'm explaining the concept. Only if I do that, you will be able to understand all these things. Fine? Right. Now, you just see what happens. Now, this is the beauty of your return on, trading on equity. Now, what happened here was, so on debt, what was the debt component? 45 lakhs. What was the equity component? 55 lakhs. What was the total amount invested into the business? Participate, guys. Quick. It's very logical. Very logical. It's just that you need to switch your perspective and see all these things. That's all. Now what happened was, every single rupee invested into the business was generating a return of how much? Gross, return on investment, 27%. Correct? Every single rupee. When we are talking about operating profit, we are not bothered about from where we are getting it. We are just bothered about how much is being put into the business. That's why costing ignores all your financing items. We saw that, right? Guys, clear with this? Now, what happens here is, for the debt holders, how much am I paying? On this 45 lakhs, how much am I paying? I'm paying only 9%. But even on this 45 lakh invested, I was generating how much? 27. How much more am I generating? Come on, how much more am I generating? I'm generating 18%. Right? Right? So basically what happens, return on equity, can I calculate like this? Return on equity, basically what do you mean by return on equity? Whatever amount that the equity shareholders get divided by their equity investment. Equity investment is how much? 55 lakhs. Denominator is sorted. How much amount they are going to get? See, every rupee invested into the business is generating 27% return. Correct? So on their 55 lakhs, they will anyways get 27%. Over and above that, on this 45 lakhs also, whatever is in excess of 9% they are getting. So on this 45 lakhs, how much is their excess? 18%. Calculate and tell me how much is the return on equity. Okay, what is the numerator, denominator? 22,95,000, Varda? Yes, 22,95,000 divided by 55 lakhs. How much is it? 41.72%. This is same as what we computed here. Guys, clear with this? Clear with this, right? So basically what happens? Why is this happening right now? Because I'm trading on equity. Basically what happens here is, when my return on investment is greater than my cost of debt, whatever is that excess amount that I am having, even on the equity, this fund of 45 lakhs was brought by the debt holders. Still, since my ROI was greater than my cost of debt, I am able to enjoy the benefit. Are you clear with this? Suppose my return on investment was only 5%. What would have happened? From my piece of cake, I need to bear it, and I need to pay them, because they are not bothered about how much you make. You pay me 9% and I'm out of it. Clear with this? Clear with this? That's why again leverage is a double-edged sword. So now, when will a leverage be in your favor? When your ROI is greater than your KD, or basically your cost of debt. Sir, why are you saying only KD? Sir, that's why I said it is happening. Leverage effect happens because of your fixed financial cost. Financial leverage happens because of your fixed financial cost. Are you clear with this, guys? Are you clear with this? Now you read it, you will understand. So does the firm have a favorable financial leverage? Yes, clearly. Why? ROI is greater than interest on loan fund, and hence it is favorable financial leverage. Or ROI is greater than interest on loan fund and it is unfavorable? No. The other three options are definitely not. Are you clear with this, guys? Right? This is the logic behind your trading on equity. Clear with this? Are you all able to understand this? Fine, let's go and update our library of adjustments. Write down standalone MCQ, leverages, and write down trading on equity. Quick, guys, let's do this. Done? It's trading on equity. Maybe if you want, you can put semicolon, ROI versus interest in this case. ROI versus interest. For you to maybe understand, you can put it. Guys, are you all clear with this? Yes, you guys are able to understand the background concept? Okay. Shall we move to the next one? So now we are going into descriptive sums, descriptive questions. Shall we get started, guys? Yes, fine. The following are the data in respect of LP enterprises for the year ended 31st of March 2024. So now basically, guys, in ratio analysis, you have a lot of formulas, right? Now every single one of those formulas are absolutely logical. You ideally need not mug it up. All the formulas are actually very, very logical. Now in this case, I think this is fairly a simple question. What they would have asked is, they would have given some ratios, missing figures, and they would have asked you to prepare a balance sheet, right? That's what they would have asked you to done. This is basically, in my opinion, this is similar to what you would have done in your school days also. In your 12th standard, I think in accounts you would have got this ratio analysis. I think to that level only this question is there, not beyond that. So it's fairly a simple question. Shall we just quickly finish it off? Yes, no, nothing great, no major complexities, because we're ready to see some really good questions as well. Okay, shall we get started? Okay, fine. So now what have they given? The following data is available. Debt to total assets is 0.4. What is debt to total assets? Debt upon total assets, right? Then long-term debts to equity, self-explanatory. Long-term debts upon equity is 30%. Gross profit margin on sales is 20%, right? The accounts receivable period is 36 days, correct? So with this you can calculate receivables turnover ratio, correct? Guys, yes, 360 upon 36, so 10. So once in 36 days I am going to make the receive, this is receivables, I am going to receive the payments, which means like that 10 times 10 cycles of receivables are there. Guys, that's how you need to understand, correct? Fine. Quick ratio, basically quick is asset test. Asset test is nothing but quick assets upon your current liabilities. What do you mean by quick assets? All the current assets minus your inventories and prepaid expenses. That's about it. Then inventory holding period is 60 days. What will you do? 360 upon 60, you will get your inventory turnover ratio. Correct? Clear with this. Then your COGS is given. Fine. Now what have they asked for? Liabilities is 20 lakhs, right? Liabilities under that. Equity is 20 lakhs, equity share capital, reserves and surplus, long-term debts, account payable. These three figures are missing. The total is going to be 50 lakhs, right? Fixed assets, inventories, accounts receivable, cash, and total. Now in this question, they have listed what are the assets and liabilities available. Clear? Based on the above data, you need to prepare, or you need to complete the balance sheet, right? And all the calculations should be the nearest rupee. Assume 360 days in a year. Now guys, very simple. I think directly we can start this off here itself. So this figure will also be 50 lakhs. Right here itself we can try to do whatever maximum possible. Please participate and close it off. Please participate and close it off here itself. Clear? Fine. Now look at this. First, what have they asked? Debt to total assets is 0.4. Right? So what's your total assets? 50 lakhs. Correct? That's going to be your liability is going to be your asset is going to be equal to your liability. Fine. So 40.4 of 50 lakhs. How much is that? 20 lakh. What 20 lakhs is? Where will you fill it? Who said long term? Did they say it's long term? They just said debt, which means these two figures put together is going to be 20 lakh. Clear? Guys, clear with this? Clear with this? Fine. Then what have they asked? So now with this you can find out the reserves. Yes. So if this put together is going to be 20 lakh, this is another 20 lakh. This is the balancing figure of 10 lakh. Guys, correct? Right? Now I need to know the breakup of this. Right? Go up and see if there is any hint available. Long-term debt to equity ratio is going to be 30%, right? So tell me, how will you arrive at this? Long-term debt upon 20 or 30? 20 or 30? How many of you say it's 30? Okay, how many of you say it's 20? Don't worry, it can be either of the two. Write a note. Okay, so yes, it can be either of the two. So this is where I always say ratio analysis, even in dividend decisions, taking whether when they give dividend it's a D1 or D0, institute keeps taking a contrary stand in every sum, right? In ratio analysis there are a lot of kind of ambiguities. You always write a note on your stand and leave it there. For your note your answer is correct. If you don't write the note, the chances of losing marks are there. That is the one thing that I keep telling students, because for the same questions, similar terminologies, institute does it in a different way. That's why if you notice in the institute study material, I don't know how many of you have seen that study material. That study material they would have clearly mentioned at the beginning of this chapter. There are multiple possible formulas for a given ratio. They would have given it very clearly. That's why I say write note. It's a life savior for you. Maybe you would have learnt it in a different way, but institute is expecting in a different way. What can you do? You can't do anything. Write a note, right? Then you are always safe. Fine. So yes, in this case you can also do anything, but preferably, my opinion, I would say that take both. 30 lakhs is correct. Very good. So tell me guys, this upon this is going to be how much have they given? 0.3. 0.3 then. Okay, it's going to be 0.3. So how much is that? This is going to be 9 lakhs. Okay. So now long-term debts is going to be 9 lakhs. Guys, correct? So what's going to be your accounts payable? 20 minus 9 is going to be 11. Done. Liability side sorted. Liability side sorted. Next, what have they given? Okay, on the liabilities asset side. So first they have given accounts receivable period is what? 36. Okay. Okay guys, first COGS is there. I think all these are turnover based ratios. Okay, so turnover based ratio. So COGS is how much? 64 lakhs. They have given the gross profit margin as 20%. Guys, correct? So basically, gross margin is what? Gross margin is basically a percentage on your sales, right? So COGS plus profit gives you what? Sales, right? So now they have mentioned the gross profit is 20% on sales. So which means if my sale is 100, my profit is 20, which means my cost is going to be 80, right? So now if 80 is 64, how much is 100? So 64 upon 80 into 100, how much is that? 80 lakhs. So basically my sales is going to be how much, guys? 80 lakhs. Guys, clear? Any problem here? Any problem? You guys are able to follow this? No, this is like simple basics of accounts. This is not even related to finance. Okay, accounts. Now. Then you have this accounts receivable. So first, which one you want to do? You can do anything you want. Okay, accounts receivable period is there. So it's 36 days is the collection period, your accounts receivable period, basically your debtors collection period. So what's going to be your receivables turnover ratio? 360 upon 36, that's going to be 10 times. Right? Right, guys? Fine. So sales divided by your basically your debtors or accounts receivable is going to be 10. So it's going to be 80 upon debtors is going to be 10. So 80 upon 10, that's going to be 8 lakhs. So your accounts receivable is going to be 8 lakhs. Guys, correct? Right? Let me just check it. Hope the second. Yes, the accounts receivable is 8 lakhs. Okay. Okay, right? Then next one. Inventories I think is direct. Once again, here you have 60 days as your stock holding period, right? So it's 360 upon 60, is it? Okay, so 360 upon 60, yeah, how much is that? 6. Fine, your inventory turnover ratio is going to be 6, correct? So your COGS 64 lakhs divided by your stock is going to be equal to 6. So 64 upon 6, how much is that? Okay, 10,66,667. Guys, any problem here? Any issues? No. Yes, right? I think that's what they would have also done. Where is it? You got it? Yeah. Here the figure is there. Then, yeah. So you can have a quick ratio. Quick ratio is what? 0.9. So basically, quick ratio, they have listed out what are the assets available here. Here, quick assets are what? Receivable plus cash. Correct? No. Yes, everything except inventories, all current assets except inventories, right? So 8 lakhs plus cash upon what is the current liability? 11 lakh is going to be how much? 0.9, 0.9. Do the cross multiplication and tell me. 1 lakh, so it's going to be 11 lakh into 0.9 minus 8 lakh, correct? How much is it? 1 lakh? 90, okay, 1,90,000, and this could be your balancing figure. 29 lakh 43,334. Okay, 333. Okay, fine. That is fine. If you put this as 4, then this should be 6. That's all. Okay, no problem. Guys, are we getting the same answers here? Yes. Okay, fine. This is fairly a simple question and it's done. Okay, guys, done. Yes, just go and update it. That's all. The scoreboard should keep ticking. Second. Okay, so write down. The type is descriptive, chapter is ratio analysis, and it's going to be balance sheet preparation, BS prep using ratios. That's all. Balance sheet preparation using ratios. I think it was fairly simple. You want to note anything in specific? That's about it. It's fairly simple. Okay, shall we move to the next one? Yes, guys. So next question. Now this question, there's one adjustment that I feel personally might be coming in your exam, right? That's my gut feel. Again, don't ask me why and all that. Somehow I feel based on the past trends that I've seen. Maybe somewhere I feel. 1 second. Yeah. It's okay. It's done. Okay, somewhere I feel there's one adjustment in this question that I feel is unique, and I think we did this also in our regular batch if you attended. But anyways, coming back here, let's do this now. Again, guys, full focus on. Okay, Nothing much of complicated thing here, but there is one thing that you need to know about this particular question. There's one little adjustment, and that's like a really good adjustment. Shall we get started? Yes, fine. Now, cost of capital. Before I start this particular question, first of all, let me just quickly give a background. Very quickly, I'll give a background. Generally, this is the first chapter that I do in our regular batch, that is immediately after time value of money. So now, in our financial management, overall, there are three objectives, right? You have financing decisions, you have investment decisions, and you have dividend decisions, right? Whatever chapter you do, it fits under either of these three buckets, right? And there is one chapter that is all pervasive, that is ratio analysis, that cannot be fitted into any of the bucket. Fine. Now, financing decision basically involves, if you are looking at a balance sheet, right? So the decision that is taken with respect to the fundraising activity is basically, it comes under financing decisions. Chapters like cost of capital, your capital structure theories, your leverages, these are the chapters that typically fit into the financing decision category. Investment decision is basically, having raised the money, what are the right avenues where I need to park my money? Typically your capital budgeting. The chapter itself is investment decisions, and to some extent you can say working capital management. Working capital management is a mix of both financing as well as investment decisions, because you need to list out the working capital requirement as well as the working capital funding, right? And finally, having done the business, right, you have some profit that is available for the equity shareholders. How much of that needs to be paid by way of dividend, and how much of it needs to be retained for your future plans, your future expansion? That squarely fits into the category of dividend decisions, as one chapter named dividend decisions itself, right? This is the overall a big picture of our FM syllabus, which you actually definitely know, since this is a revision RTP discussion right now. Now, this chapter, cost of capital, this, as you all know, this fits into the first bucket of financing decisions, that is the sources from where I'm going to raise the finance, right? And when I'm going to source money, I will go for those options which are going to give me the least possible cost. That is the overall objective here, right? Now, on that note, let's get started. I'm just giving you a background, that's all. Now let's get started. Now, BS Limited has the following capital structure. What do you mean by capital structure? That is mix of sources of finance, that's all, right? That's called as capital structure. At book values as on 31st of March, equity share capital 3 crores, right? And there are 10 lakh shares. If you divide the two, you get the number of the face value, you will get it. Yes. Then 11.5% of preference shares, 10% debentures you have, right? And the total capital employed into the business is going to be 4.6 crores. The equity shares of the company are sold for rupees 300. It is expected that the company will pay next year a dividend of rupees 15 per equity share, right? Which is expected to grow by 5% per annum forever. And assume a 35% corporate tax rate. Required, number one, compute the weighted average cost of capital of the company based on the existing capital structure. This is nothing. This is like a plain direct question. The second part of the question is where things become a little interesting. That one adjustment, that's a deal breaker in this question. Compute the new WACC if the company raises an additional 50 lakh debt by issuing 10 years 12% debentures, but the yield on debentures of similar maturity and risk class is going to be 13%. Flotation cost is going to be 2%, the face value of the debenture is going to be 100, and this would result in increasing the expected equity dividend to 20 rupees and leave the growth rate unchanged, but the price of the equity share will fall to 250 rupees per share. Now forget the second part, let's do the first part. Okay, second part I will come to it. Now, first of all guys, before we start, every source of finance will have its own cost associated to it. Correct? The cost of preference shares is popularly called as KP, your debentures is called as KD, cost associated with equity is called as KE, right? When it comes to KE calculation alone, there are multiple methods in which you can calculate. Reason, because that is the nature of the instrument. If you look at all other instruments, you have a contractual obligation to pay some fixed amount, be it preference or debentures, right? Whereas in equity, it's not the case. Right, because the company can issue dividend or they need not issue dividend, right? So these people are the owners of the company. Because of the nature of this particular instrument, there are multiple angles from which you can value. Basically, when I say a KE calculation, it also invariably means that valuing your equity shares also. Fine. Now in this question, based on the data given, it can be clearly visible that what you need to use, which is the method you need to use? Dividend growth model, popularly called as Gordon's model, right? Under the Gordon's model, how will you calculate KE? What is the formula? D1 by P0 plus G, right? All this derivation we have done it in detail in the regular batch, but right now derivation part we can't do it, but D1 by P0 plus G, right? Now you have all the figures here. With this you can directly calculate what is D1 here. It's going to be 15. P0 is basically the current issue price, or if I go to the market today and get it, it's going to be at the current market price of 300, right? Plus G. How much is the growth rate? 5%, right? If you calculate, you will be getting it. 10%, huh? Okay, is 10%. K is how much? 10%. Okay, fine. K is done. Right, guys? Fine. This is how you do it. Now, with respect to preference and debentures and all that, right? It depends on its nature. It depends on its nature. You should see whether it's an irredeemable nature or redeemable nature, right? If it is an irredeemable nature, let's say we are talking about KD calculation, right? If it's going to be irredeemable, right? Irredeemable nature. So the formula for KD is going to be your I into 1 minus T upon your net proceeds or P0, whatever it is you want. Basically, it's nothing but this is derived from the time value of money calculation. Numerator should have what I pay and denominator should have what I receive. But this payment should be adjusted for taxes since interest is a tax deductible expense. Clear with this? Suppose it is in the nature of a finite period. If it is in the nature of a finite period, what you need to do is, again, there are two methods of doing it. One is popularly known as your yield method, also known as IRR method, right? And the other one is called as a shortcut method, which is also known as your formula method, right? In the absence of information, you can definitely do the formula method. Yes, come on guys, tell me what is the formula for calculating KD for a finite life? KD is equal to I into 1 minus T plus RV minus NP divided by N divided by RV plus NP divided by 2, right? It's a very, very logical formula because let's say I'm issuing it at 100, redeeming it at 110, and it has an interest rate of, let's say, 10%, right? When I'm saying the cost of debt, it is not just my interest rate, because if you see, when I took the money from the investors, the debenture holders, I got only 100, but when I'm repaying it back to them, I'm going to pay them 110, which means I'm paying them 10 rupees extra. But this 10 rupees extra is not for 1 year. It is for a period of the life of the asset. Let's say the life of the asset is going to be, or asset. This is an asset from the viewpoint of the investor. Okay, the life of the instrument is going to be 10 years. Then what you need to do is I into 1 minus T, because this is a tax deductible expense. This is one component there, plus the difference between my redemption value and my initial issue price, that is my net proceeds. This 10 rupees is also a cost. But wait, that is not an annual cost. That is a cost that needs to be amortized over a period of 10 years divided by the life, right? So in the numerator now you have what? You have the entire cost that you are incurring. Denominator, you should have the capital. That is basically the amount. What amount will you take? The initial amount or the final amount? Take a simple average of the two. This is the logic for the formula. Clear with this, guys, right? Now suppose if the same thing is about your preference, instead of I into 1 minus T, put it as preference dividend. There is no tax adjustment because dividend is not a tax deductible expense. As simple as that. Clear with this? Are we all on the same page when it comes to this? Fine, guys. Now on that note, yes, this entire sum has been solved like this. The first part of the question is direct. The first part of the question is direct. So first, the cost of KE calculation is 10%. Direct. Guys, any problem here? No, right? Then cost of 10% debentures. They have not given anything with respect to your, the market price of debentures and all. So you can assume the face value as the market price. Yes, that shouldn't be a problem. Yes, so you can do the total calculation here. So what they've done is, so look at this, the capital, the debenture value is going to be 1 crore. So 1 crore to 10% is going to be 10 lakh, right? So 10 lakh into 1 minus T, right, upon 1 crore, you get 6.5%, correct? So KE is 10% and your KD is going to be how much? 6.5%. KP, they have not given anything, right? And directly there is no tax adjustment also. The entire dividend is the only cost for you, right? So it's going to be directly 11.5, or if you want, you can also plug that formula that I said, but RV will be equal to your redemption value will be equal to your net proceeds, right? And denominator also RV will be equal to NP. So basically the only cost that you have is dividend. which is already a percentage on your face value because your face value is equal to your market price. Since in the absence of information, directly you can take KP as what? It is as 11.5%. Clear with this, guys? Yes, the values are all given in the question. Yes, with this you do the weights. Guys, yes, all these are basics. These are basics, right? So what you do? So the final, how will you arrive at KO? KEWE plus KPWP plus KDWD, the weight of that particular instrument. So weight of debt into cost of debt, weight of preference plus into cost of preference, and so on, right? You do it, and finally you arrive at the weighted average cost of capital of 9.44. Any problem here? Yes, this is fairly a simple area. No, not much of complexities involved in it, right? Shall we move forward to the next one, guys? Yes. Now comes an interesting thing. Now, presently the company has a total capital of 4.6 crores, right? But guys, please be attentive. This is what I feel will be tested in your exam. This is somewhat I feel that it could be tested in the upcoming attempt. Look at this. The new compute the new WACC. The company raises an additional 50 lakh rupees of debt by issuing for 10 years at the rate of 12% debentures, but the yield on debentures of similar maturity and risk class is 13%. Flotation costs and all these other data are given below. Now tell me, guys, so how do you proceed about with this question? Or let me ask you one question. What is the missing data in this particular segment? Net proceeds, or basically the issue price. Should know the issue price, no? Correct? For the purpose of calculating net proceeds. Now, sir, if nothing is mentioned, we can take face value. So then why have they given all this yield and all that? So basically, guys, this yield, whatever given here, is basically given for you to calculate the issue price, right? First of all, knowing that this is being given to calculate the issue price itself is an issue, right? And then let's think about how to calculate. But here, you can't take an assumption that since the question is silent about the issue price, I will take 0. I mean, I'll take is equal to 100 or face value. No. Then why have they given this? So how do we go about with this? Once again, there are a lot of formulas given and all. Logically, you just attack this. Now, basically, what is it? Just imagine you are a debenture holder. You are an investor. You want to invest in this particular company's debenture, right? Now, the company, they have made it very clear what is going to be the coupon rate. What is the coupon rate? 12%. Correct? So, if let us say the debenture, every debenture is having a face value of 100 rupees. Now, tell me, face value, can it be changed? No. Coupon rate, can it be changed? No. Coupon rate, it will be the same only. Now, if I invest 100 rupees, I am talking from the viewpoint of debenture holder, right? Yield is always from the viewpoint. In this case, it is from the viewpoint of investor. What he says is, if I invest 100 rupees, how much will I get? 12. So basically, if I buy every debenture, I will be getting 12 rupees, not percentage. 12 rupees I will be getting for every debenture I purchase. This is what the company is saying. Correct? Now, how much should I pay? That is the issue price. Correct? From my viewpoint, that is my investment. From my viewpoint, 12 rupees is my return. Forget taxes. That's why I'm saying here you're looking at it from the viewpoint of the investor, right? He says, today if I go, I am expecting a return of 13%. Now does it make sense? Right? So you make this 12 rupees equivalent to 13%. So accordingly fix your issue price. This is how certain shares are issued at premium, certain shares are issued at discount, which you have studied in accounts. But how do they know whether to issue at a discount or a premium? Yield concept of financial management. Are you clear with this? This is how it works. Guys, yes, you guys are clear with this, right? Now you can calculate 12 divided by 13%, you arrive at the issue price. How much is that? Sorry? 92 point something 31 and all that, right? From this, so you arrive at the issue price. Now once again go back to the viewpoint of company, right? Because the entire chapter is from the viewpoint of company. Are you clear with this? Right? This is from the viewpoint of the company. However, since yield was given, that component alone, we switched our mindset from the viewpoint of investor and we came back. Right? Now this is not my net proceeds. Why? I have a flotation cost. Now once again another ambiguity here. Flotation cost is 2% on what? very strictly speaking, on the issue price, underwriting commission, these are all flotation costs. On the amount involved only you will be incurring. But some sums institute is applying this percentage on issue price, some sums they are applying it on the face value. In this question they have applied it on face value, right? They have done it like that. Sir, how do we know? You will not know. Write a note. That's where I said. Clear with this, right? Beyond that even I cannot do anything, right? But the basic thing, yes, if you write a note, it will definitely be accepted. Clear with this, guys, right? So what they have done, they have reduced this 2 rupees. So net off it's going to be 90.31. Clear with this, guys, right? Whatever is the decimals, they have rounded it off. Are you all clear with this calculation? Logically, are you all able to understand? If this comes in exam, will you be able to crack it? Yes? Fine. And apart from that, because of this, once again you need to redo your KE calculation. That is fine. So now D1 by P0 plus D. Yes, D1 is going to be 20. P0 is going to be 250. Yeah? Yes, and the GE was 5%. 5%. You do it, you redo it, you will get it. Clear with this? Yes, and yes, that's all. Apart from that, one more line item will be that this is going to be 50 lakh rupees of 12% debentures, but when you are doing it, KD calculation for this component will be different based on what? This new issue price. Clear with this? Now let's quickly do it. That's about it, guys. That's about the sum, but let us do this. So now if you look at this, so this equity share capital preference 10% debentures, now newly one 12% debentures has been added. That's all. Correct? Now because of this, right, you need to do the KD calculation, right, for this particular line item, and they are saying because of this presence KE is also changing. This will also be a new calculation. These two will remain the same as what we did before. That will not be impacted. Correct? Clear with this? So this 13%, how did you get? So new dividend 20 upon 250 by 0.05, you get this 13%. Done. Now this 12% debentures, how do you get it? How do you get it? Look at this. So it's going to be the same formula, interest into 1 minus t, 12 into 1 minus 0.35 plus redemption value, nothing is mentioned. This you can assume that redemption will be at par. Correct? Yes, 100 minus this 90.31 that I just calculated right now. Guys, clear with this? This is all, this is the main part of this question, right? See, just imagine if you do this wrong, you will get the KO also is wrong. It will be a chain error. They will not give you a single mark for the second component. Fine, guys, clear with this? Are you all able to understand this? Right? And they have applied this formula and they have arrived at 9.21% that has been mentioned here. The other two are intact. Accordingly, they have calculated the weights and now they have arrived at the weighted average cost of capital. Guys, are you all clear with this? Are you all clear with this? Yes? Is it clear? This adjustments you guys were able to understand? Right? Okay. So I think they have done this. Since the yield on similar type of debentures is 13%, the company would be required to offer dividend at their debentures at a discount. Are you clear with this, guys? You guys are able to follow this? Was it logical? Yes, right? And that's what it is. They have arrived at 92.31 minus 2 and they have arrived at 90.31. But just imagine, if you just look at this, you might not be able to understand. They have not done any calculation. They have just mentioned it. 12 divided by 0.13. Why, sir, you did it? That will be the question. Guys, yes. You guys are able to follow this right now? Okay, fine. So shall we just go and update our library of adjustments? Okay, let's do it. Write down, quick. Write down. Okay, guys, write down. The descriptive, the chapter is cost of capital. Write down WACC for existing and new capital structure. WACC for existing and new capital structure. Semicolon, calculation of IP, that is the issue price, IP of new debentures using yield within bracket percentage, of new debentures using yield within bracket percentage, of new debentures using yield within bracket percentage. Fine. So now we'll do a small sequence change. So let's go to working capital chapter, working capital management, and then we'll come back to the remaining sums. There are two questions in this attempt's RTP on working capital management. The one question is regarding your working capital estimation, and the other question is regarding your receivables management, like evaluation of credit policies. There are two questions. So let us just get started with working capital management right now. Guys, yes, you ready?
Yes, sir.
Okay, fine. Now, this chapter, working capital management, as I was just telling you quite some time back, it fits into the category of both your investment and financing decision, with a rider that it is not long term in nature, right? So in this chapter you will generally not be seeing your present value tables and all of that, and this chapter has something to do with your costing also, your cost sheet and all of that. So basically let me just give you an overview as to what working capital management is, what working capital is. Working capital is current asset minus current liabilities. This is the bookish definition which you have seen, but why is it so? So before we get into it, first let us understand what is working capital. I just want to give you a brief overview and then we'll move to the question. So now, let's say I am bringing some 100 crore rupees of funding to my business, and I invested that in all my fixed asset in my factories, right? Factories, equipments and everything. Now, can I start my production? Just the presence of all your fixed assets cannot convert your raw material into FG by itself. So basically, you need some running and operating expenses, correct? You need to also fund some amount for your day-to-day operations. Agreeing with me on this or not?
Yes, sir.
Guys, yes, yes, yes?
Yes, sir.
Right. Now, this is basically called as working capital. Now, working capital is not an expense. It is basically an investment that you put into the business, right? Yes. So now, apart from your fixed asset, you will also need to first introduce some money, pump in some money to buy some raw materials, right? And for the first time you're starting a business, you also need to bring in money for your wages, for your salaries, for your day-to-day operations. For the first time ever, today you are starting a business. Apart from your overall fixed investments, you will also need to bring in some money for the purpose of your operations. Agreeing with me, guys?
Yes, sir.
Agreeing with me? Carefully listen. You will need to bring this amount for your operations. Basically, that is where for your current assets, basically your stock. Let me just take stock for the, for starters, let me just take stock. I need to bring in some amount for purchasing raw material also. Apart from that, for me to convert this RM into FG, I will be having to spend some kind of other labor, overheads and all of that. So for that also I need to bring in some money. So first I need to bring the money, correct? Only then I can even start my production. Now what happens, let us say for example, it takes on an average 30 days for me to convert this RM into FG, and further on, once this gets converted, this RM gets converted into FG, will I immediately get money? No. What happens? Maybe I'm selling it, right? And when I'm selling it, will I immediately get cash? Some guys will tell me that, look, I'm not going to pay you immediately, give me some credit. Let's say they are taking some 15 days or 20 days, they are taking their own cool time. So what happens is, on an average, what happens? It takes 50 days for me to get the cash that I pumped in. Correct, guys? But the moment I get the cash that I pumped in, when I'm going to start the next cycle, the cash released from the previous cycle can be used for the next cycle. Guys, correct? So I need not fund for the second cycle. The moment the second cycle is over, the cash released from the second cycle, I can put it back to the third cycle. So again I need not bring in funds. Correct? So basically working capital is a long-term investment. But the first cycle alone you fund it, the cash released from the first cycle will fund your second cycle, and it goes on and on and on and on. But you will not get this, whatever amount that you pumped in initially, you will not get it immediately. When will you get it? You will get it when you shut down your business, because till then it will be running into your business. Clear with this? That is why in capital budgeting, if they are saying the firm brought in 20 crore rupees of working capital is treated as an outflow in the initial year, and it is treated as an inflow in the year at the end of the project. Are you clear with this, guys? You are able to understand now? Yes. Now what are you going to fund? You are going to fund your operations. And sir, why sir in current assets debtors are there? Like debtor, how am I going to fund it? Basically, debtor value is nothing but there is some amount that is getting blocked for, in our example, 20 days, correct? That 20 days worth of cost, whatever is getting blocked, that should have been brought into initially. Guys, correct? Guys, correct? That is the debtor value that I am taking for the purpose of calculating my working capital, because this amount also needs to be funded. Who is going to fund it? Yes, I will have to look for some other sources of finance for that. Are you clear with this? Are you clear with this? That's why we add up all the current assets for the purpose of calculating your working capital. But wait, now during the course of my business, by default in the operational level itself, there is some small level of funding happening. Creditors are saying, don't worry, you need not pay today itself. I am giving you some 20 days of time. So that need not be brought today. Correct? That cycle itself will take care. I will reduce all the current liabilities. The net amount alone needs to be brought into the business initially. That is why we say current assets minus current liability is called as working capital. Are you clear with this? Yes, yes. This is the holistic view of working capital management. Now, working capital should be invested, yes, into the business. And when I say I am bringing an investment, you should also look for funding, right? So some components of this working capital are naturally funded in the operational level itself. Current liabilities, it could be short-term borrowings, it could be your current, basically your creditors and all that, accounts payable and all that. But whatever is the amount in excess of current asset minus current liability, that generally you need to fund it from your long-term sources, because this is not something that gets released immediately after 60 days. No, then once again you will have to put it back in the next cycle, and the cycle keeps going on and on and on till you shut down your business permanently. Are you clear with this? But remember this working capital, sir, then one time I invest and that's all, provided you just want to stay in the same way. If you're going for expansion, then once again your working capital level will increase. At that time, once again you need to infuse, but whatever you infuse, you will get it back at the end. Suppose you are downscaling, then maybe to that extent it gets released out of your cycle. Are you clear with this? When I say debtors, let's say, and in the balance sheet debtor value is 20 crores, it's given. It means what? It's not on the balance sheet date. At any given point of time, 20 crore rupees is receivable to me. Correct? You take on any day, 29th of Feb or 28th of March or 21st of Jan, you take any day, on an average, this amount is always receivable to me. So then when will I receive it? Only if you permanently shut down your business, you will receive it. Because today some person might be a receivable for you. By the time he pays you, you might have sold some, again worth something worth 20 crores and some other person would have been receivable. Are you clear with this? So this keeps on going. That's why at any given point of time, the working capital components will be, it will be there throughout during the life of this particular company. Are you all clear with this, guys? Right? Now, this one chapter is generally confusing for many students. And as someone requested, that's why I wanted to do a sequence change and do it right now itself, for a simple reason that we might have seen this chapter from an accounting perspective. Only when you open up about this chapter from a finance perspective, this will all add up. Yes, guys, this is a basic overview of this particular chapter. On that note, shall we get started to the next question? Yes, shall we get into the next question? Yes. Now, working capital. TMT is commencing a new project for manufacture of electric toys. The following cost information has been ascertained for annual production of 60,000 units at full capacity. So, the company has a capacity of how much? 60,000. Whether is that the actual capacity or not, we'll know as we proceed and read into the question. So, raw material cost per unit is 20, direct labor is going to be 15, manufacturing overheads, variable component is 15, fixed component is 10, the total is 25. Now, remember one thing, guys, the fixed component remains fixed irrespective of your volume. This 10 needs to be multiplied with 60,000. So, ideally speaking, they have unitized it, but you should read it as 6 lakh rupees. Whether it is 60,000 units or 15,000 units or 0 units, it will remain the same. That's the nature of fixed cost. Correct? Only the variable component varies with your units. Clear with this? Costing concepts only. Right? Your selling and distribution expenses, overheads, variable and fixed is given. So the total cost is 64. The profit per unit is 16. The selling price per unit is going to be 80. Clear? This is what is given. In the first year of operations, it is expected, the expected production and sales are 40,000 and 35,000 units respectively. So what are they saying? This is a new business being started for the first time. Obviously, they don't have an opening stock, right? They're going to produce 40,000 and they're going to sell how much? 35,000, which means 5,000 units is going to be stocked. Clear with this? Any issues here? No. Next, to assess the need for working capital, the following additional information is available. So first, Stock of raw material, 3 months worth of consumption. What they are saying, raw material stock, the company will generally keep 3 months equivalent of annual consumption. They will have it. Why? For safety purpose. Tomorrow some order comes in, they should always be having. So every time you get an order, you can't call your supplier and ask him to deliver, right? You should always have some stock. Correct. Company stock policy is 3 months. Clear with this, right? Then you have credit allowable for debtors is 1.5 months, which means if I make the sale today, only after 1.5 months I'll be able to recover the money from them. Credit allowable by creditor is going to be how much? 4 months, right? So now just by looking at this itself, you can know that the company has a very good working capital position, because when they are selling, they will recover it in 1.5 months. But when they are going to get the credit, they need to pay it only after 4 months. It's a good deal that they have struck. Are you clear with this? See, these are certain things that you can actually find out when you're reading companies' financials, right? So companies which have these kind of good things, I mean these kind of good working capital position, you can know that these companies are dividend paying companies, because only if you have cash you can pay dividend. Right? If you're not planning your working capital, you can book a lot of profits, you'll be paying taxes, but no one will pay you dividend. Are you clear with this? This is where your financial analysis comes in. We chartered accountants or CS students, we all know how to draw up financials, but how many of us know how to read and interpret the results? Right? That's where the MBA guys come and take over. But ideally, we know every single component, whatever is there in the financials. But if you have this analytical ability, that's where you stand a chance outside in the market also. Coming back here, lag in the payment of wages, 1 month. Lag in the payment of overheads, half a month, which means 0.5 by 12. Cash in hand and bank is expected to be 60,000. Provision for contingencies is expected to be 10% of the working capital requirement, including that provision. So be very clear. So it's going to be 10 by 90 and all that. It's not flat 10%. Clear with this, guys? Yes, yes, yes. Fine. Now you are required to prepare a projected statement of working capital requirement for the first year of operations. Debtors are taken at cost. Right? What do you mean by debtors are taken at cost? Basically, when I'm saying I need to fund, so debtors are going to take half a month, 1.5 month. Yes. So 1.5 months of funds that get blocked in my debtor, I need to bring it first. Correct? No. Yes. Now I will not take the sale price, because profit is a figure that is not got blocked into the business that you're going to earn. What gets blocked is only the cost of sales on the goods sold. Are you clear with this? So that's why they are asking you to prepare this working capital statement at cost, cash cost basis. This is actually one of the methods of working capital. Even if it is silent, I would suggest that do it on cash cost, because that is the right method, because profit doesn't get blocked into the business. When you are investing something, you don't invest the profit, no? Correct? You bring money only for the cost incurred, right? You won't bring money for the profit that you are going to generate. Are you clear with this? Fine, right? So now let's do this quickly. This is question number, guys, 10 now. Yeah, 10. Now look at this. Please have the question with you. Please have the question with you. Now, first, what have they said? The annual production capacity is how much, guys? 60,000. And they're going to produce 40,000 and they're selling how much? 35,000, which means they're going to stock how much? 5,000 units. That's very clear, right? Now, what is going to be the sales revenue? 80 rupees for every unit sold. Guys, correct? Yes. Basically, first thing that you need to do is prepare a cost sheet. The first thing that you need to do is prepare a cost sheet. This is nothing but your cost sheet. Clear with this? Why do we prepare a cost sheet? Only then you will know for which component of your working capital how much is the fund that gets blocked. Are you clear with this? Right? So first, sales revenue, 80 rupees every unit I sell, I get, and 35,000 units I'm going to sell. That's going to be 28 lakhs. Any problem here? No. Then the cost of production, materials, 20 rupees per unit. So 20 into 35,000 is going to be, sorry, it's 40,000. I'm sorry. Because, wait. The costs are incurred for the units produced, and finally you do the stock adjustment. Guys, correct? Your cost sheet is tied up to your production. Correct, guys? You incur costs not just for the units you sell, even for the units that remains unsold. Correct? That's why stock is valued separately, and finally you reduce it while arriving at your profit. Guys, correct? Matching concept, no? Right? So it's going to be 20 per unit into 40,000. Right? It's going to be 8 lakh. Similarly, your labor, they have given all these things unitized. 15 into 40, how much is that? 6 lakh rupees. Manufacturing overheads, a variable component, 15 into 40,000 again, it's going to be how much? It's going to be 6 lakh. And fixed component is going to be 10 rupees per unit into 60,000. This I told you, it's fixed, right? It's going to be 6 lakh. So overall cost of production is 26 lakhs, right? Now what do? You know that 5,000 units are your closing stock, correct? So for the purpose of arriving at your profit, so whatever cost that I've incurred right now is the cost of production. So reduce the stock value while knocking it off against your sales. So how do you do it? If 26 lakh rupees is the value for how many units? 40,000 units. How much is going to be the value for 5,000 units? Or if you unitize this, is nothing but your cost of production per unit. That's all. In costing, that's what we call it as. Or if you want, you can maintain a separate column called per unit column. If you want, you can do that, right? So you unitize it and value this 5,000 units. So it gets how much? 3,25,000. You reduce it. The COGS is going to be how much? 22,75,000. Clear with this, guys, right? To this, add back your selling and distribution. Selling and distribution. So now selling costs are incurred only on the units sold. So you are not going to incur your selling cost on the units that you are keeping in your stock. Clear with this? So this is directly only on the units sold. These are some things that you need to be very careful about, right? So 3 into 35,000, 1,05,000, and they have set some fixed cost of selling expenses. So what could it be? For example, depreciation on delivery vans, right? Or your sales depot rent, right? So these are incurred no matter what. They had unitized and kept. Ideally fixed cost should not be unitized, but for presentation purpose they have unitized it. 1 into 60,000, 60,000 rupees anyway should be knocked off. It's an expired cost, as we call it in your period cost, as we call it in our costing, right? So add it up. This is the total cost of sales in a year. For the sales I am making, this is the cost I am incurring. Are you clear with this? Yes. So now what's going to be my profit? 28 lakh minus 24.4 lakh. My profit is going to be 3.6 lakh. This statement you keep with you. We have not yet started what? Working capital. This statement we need. Why? As we proceed, you will be knowing, right? Now first, statement of working capital. Now first, stock of raw material. What have they mentioned here? Stock of raw material. So they are saying, so it's going to be 3 months of consumption they are going to stock it. 3 months of consumption they are going to stock it. So 3 months of consumption, how will you know? 8 lakh is the consumption material consumed for a year, right? How much will it be for 3 months, right? So it's going to be 2 lakh. Remember, we are only going to fund one cycle. Why? Because the second cycle gets funded by the cash inflows, the cash flow released by the previous cycle, and life goes on and on and on forever. Clear with this? Only one cycle needs to be funded. That's why I prepare a statement for that cycle alone. Clear with this? Clear. Here we are taking cost sheet as the base to find out what is the base on which I should calculate all the costs, the funds that I need to bring in. Clear with this, guys? Clear with this? Right, a very thin line of difference. Are you all able to understand? I've seen students who do this 3 by 12 and all, they know, but they don't know why they are doing it. This is the reason. Clear with this? Fine. Similarly, stock of FG. Stock of FG, right? This we have already got it here. What is it? 3,25,000. Guys, yes. FG. At any given point of time, I should have 3,25,000 worth of stock, which means at the time I'm starting also, I should have brought it in. Clear with this? Right, so this amount needs to be funded and pumped into the business. Without this, I cannot start my production. I can't start my business. Correct? This amount also needs to be brought in. Right? Next, debtors. Debtors. With respect to debtors, so what do you sell to the debtors? Raw material or FG? FG. Obviously, FGs are only sold. Now, when I'm selling to debtors, right? So with respect to the debtors, right? For the units sold, what is the corresponding cost? 24,40,000, which is nothing but cost of sales. Correct? That is the amount that gets blocked. Correct? And to the debtors, I am giving how much? 1.5 months. Yes, 1.5 upon 24. So 1.5 upon 12. So 24.4 lakhs into 1.5 divided by 12. Other than they have mentioned it as 33 by 24 and all. Don't worry about it. Write it as 1.5 by 12. It's okay. Right? So it's going to be 3,05,000. Correct only? No? Yes, right? Fine. That's all it is. And they have said apart from this, bring in cash also. Right? Why? They are saying for any exigencies you need this money. Right? Are you clear with this? Have a safety buffer of 60,000 rupees. Overall, the gross working capital, also known as current asset requirement, is going to be 8,90,000. Now, should I bring in 8,90,000? Wait, you need not bring it in, because during the cycle itself, there is some level of funding happening on the grassroots level. So, account for that also, only the net amount you need to bring in. Are you clear with this? That's where they are coming in. First, creditors. Creditors are for what? Materials or for FG? Obviously, you buy only what? Raw material. Now, there's an interesting calculation here. It is 10 lakhs on which they are computing. It is not on 8 lakhs. Why? Sorry? Seri. See, for a year anyways, I need to produce whatever it is they have said, 40,000 units, correct? For the production, I am consuming 8 lakh rupees, correct? Correct? Now, apart from that, they are also saying you need to maintain a raw material stock of 2 lakh rupees. So, when I purchase in a year, I will be purchasing for both my consumption as well as for my stocking.
Yes, sir.
Guys, correct? If I were to prepare a raw material ledger, right? Opening stock of raw material plus purchases, this is the total raw material available, right? Out of this, partly you will consume and partly will be my closing stock of raw material. In this case, opening stock is not there. Whatever, how much should I purchase? So your total consumption plus closing stock, correct? In this year, I have consumed a total of how much? 8 lakhs. But it is not enough if I just purchase and keep this 8 lakh, because they are saying you should also have a stock of 2 lakh, of raw material stock itself is 2 lakh. So I need to also purchase that. Guys, clear with this. Many students make a mistake here. Many students make a mistake here. This 10 lakh is nothing but 8 lakh plus 2 lakh. This is the total annual purchases that I am going to make. I need not bring in 8 lakh rupees now itself. Only one cycle's worth of creditors value I need to bring in. One cycle's equivalent of annual purchases I need to bring in. If I fund the first cycle, then every cycle will go on by itself. Are you clear with this? So how much he is saying? He is giving me a time limit of 4 months, 4 upon 12. So technically speaking, he is bringing in funds worth 3,33,333, but he is not bringing it in cash. He is bringing it in kind. Are you clear with this? Why? Because today I need not incur without paying any rupee, with paying 0 rupees, I am able to get stock worth 3,33,333 in my first cycle itself. That is the meaning of this. Clear? So this I reduce it because I need not bring this figure. Are you able to understand now? Yes. Guys, yes. Similarly, creditors for expenses. So expenses when they have said, for wages, how much is it? 1 month. Wages is how much? 6 lakhs is the wages. Correct? Guys, 6 lakh is the wages. Wages, what you will do is, you will make them work and at the end of the month you will pay. Correct? No. Right? So that's a 1 month time gap. That's what they have mentioned, no? Right? So 6 lakh into 1 by 12. So technically speaking, 50,000 rupees worth of, funding is being always funded by them. You won't pay them on a day-to-day basis. Like if your dad is working somewhere, does he get paid every month? I mean every day? No. At the end of the month for whatever work that he has done, they will be paying. Correct? So technically, he is also funding the business. Are you clear with this? Maybe to the extent of whatever little that he can, but he is also funding the business. Clear with this? Right? They are extracting the work, but they are paying later on. That is basically an indirect way of funding that has been beautifully designed inside my working capital cycle itself. Are you clear with this? Yes. Just change the perspective. That's all. That's all. This chapter is right in front of you. Right? Now, all other expenses apart from this. What are the other expenses? Forget your material and labor. All other expenses. 6 lakh plus 6 lakh plus 1,65,000. How much is it? 13.65 lakh. 13.65 lakh. Okay, so 13.65 lakhs, right? That is being funded to the extent of what? Half a month, no? Right? So don't write all this into 0.5 divided by 12. Correct, you do. You get that also here. So now what do you get here? The total liabilities is going to be 4 lakh and 40,208. So the net working capital requirement is going to be 4,49,792. Guys, clear with this, guys? Clear with this, guys? Right? Apart from that, they are asking you to provide for some contingencies. They are saying 10% on the estimated working capital, which means what? If my estimate is 100, yes, this has to be 10, which means whatever figure that we have arrived at was only 90. Correct? So basically what they are asking you is on this figure apply into 1 divided by 9. You get this extra provision. What is this extra cushion? Because you can't predict to the point, to the decimal, extra figure that you have. So the overall working capital requirement is going to be how much? 4,99,769. Are you clear with this, guys? But all these things, are you now able to understand why we are doing it? Right? That is the most important thing. Clear with this? And you are only funding for the first cycle. And that cycle will take care of the remaining cycles that go on in the business. Clear with this? Yes, you guys are able to follow? Right, guys? Fine. And that's about the sum. That's about the sum. Fair enough, right? Just go and update your library of adjustments. Write down. Write down. Write down. This is question number 10. Descriptive working capital management. Write down. Working capital statement within bracket cash cost. Working capital statement within bracket cash cost. Semicolon, there is one interesting adjustment. Calculation of creditors. that creditor calculation, generally students go wrong there. Yes, because they take only the raw material consumed. Remember, you should also consider for raw material stock. Raw material stock needs to be considered, right? So calculation of creditors. Right, guys? Done? Are we done here? Yes? Shall we move on to the next one? Okay, so the next question is regarding what? It's regarding your receivables management. Now guys, so basically when I'm running a business, okay, so I can define or I can coin my credit policy. If I'm selling today, so whether should I give my debtors 20 days credit period or 30 days credit period or 45 days credit period or so on. I need to decide, correct? This is one very challenging decision that I need to take, but how will I take? You tell me as a thumb rule, which is better, more or less? Lesser the better. Why? So if it is lesser, so my working capital investment that I need to pump in will also reduce. So that many days worth of cost that needs to be blocked, that I can reduce in my funding itself. Clear with this, right? So obviously it makes sense only to make it lesser. But what happens is, see, when there is an advantage, there will be a disadvantage, right? What happens is, when you do this, there will be what? You will lose out on many sales. What if your competitor is offering 60-day credit period? Yes, your customers will not come to you. So there is a competition. Obviously, there is always a balancing act that goes on in business, right? So there is one advantage, there is another disadvantage. The advantage might be by way of lesser, the interest on the funds that is getting blocked in the business. You save on that, but you also lose out on the contribution that it can generate on the sale that is being lost, correct? So now what you need to do here is, for each of the credit policies, what you need to do is, you need to arrive at the profit that it generates, that is the final profit, the expected profit under each of the alternatives, and go for that alternative that gives you the highest profit. Are you clear with this? And when I'm saying profit, I am not just talking about the book profit here. You should also consider the opportunity cost. That is basically, so if there is, in each of the cases, there will be some funding that goes into it, right? On that, whatever is the cost of capital, that is ideally a cost. Are you clear with this, guys? Let's say I'm bringing in 100 crores. On this 100 crores, the overall cost of capital is 10%. So technically speaking, 10% on 100, 10 crore rupees is a cost for me, no? Guys, correct? That also I need to factor into account when I am evaluating the credit policies. Clear with this, guys? Now, that was a brief introduction. Shall we just get started? Once we move into the question, you'll be able to understand. Right, let's do this, guys. Bano Limited is considering relaxing its present credit policy and is in the process of evaluating two proposed policies. Currently, the firm has an annual credit sales of 225 lakhs and the accounts receivable turnover ratio of 5 times a year, right? The current level of loss due to bad debts is going to be 7,50,000. The firm is required to give a return of 20% on investment. Basically, their cost of capital is 20%. Required rate of return is basically your cost of capital, right? What is required is at least your cost, correct? That is the meaning of that. Yes, the hurdle rate, as we saw in a previous question. In the new accounts receivable, now the policy option 2 requires a manager to manage the receivables with a salary of 50,000 rupees per month, right? Which means how much is it per year? 50,000 into 12, 6 lakh per year. The company's variable cost is 60%. Basically, your PV ratio is going to be 40%, right? Given the following information, which is a better option? Present policy, policy option number 1 and policy option number 2. So in each of the policy, what is the credit sales, annual credit sales that is given? Receivable turnover ratio is given. Why have they given this? With this, you can find out the collection period, or in other words, whatever is the time that you're giving, credit period given to the customers, you can arrive at it. How will you do it? 360 divided by this. In a year, I recover 5 times, which means how long it takes for me to recover one cycle is equal to how much? 360 divided by 5 or whatever, 365 divided by 5, whatever it is. Clear with this and so on. Are you clear with this, guys? Are you clear with this? And here there is lesser number of times I recover, which means per cycle I am giving a more time. Are you clear with this, guys? Yes, all these things, yes, you guys are aware? Fine. And bad debt losses under each of these options are also given. What you need to do is simple. Under each of the policies, you arrive at the expected profit that you're going to earn. Go for that option that gives you the maximum profit. Are you clear with this, guys? Yes, fair enough. Shall we get started, guys? Shall we get started? Now, first, this figure is given here. So first, expected profit, that's what we're calculating. The credit sales under each of the alternatives are given. Guys, these figures are given? Yes. So variable cost, how much is my variable cost? 60 percentage, so 0.6 on the respective credit sales. I know that this is going to be my cost. Guys, correct? Yes, yes. Apart from that, manager's salary is there, but this is there only under the last alternative, that is present, proposed 1, proposed 2. Only in the proposed 2 policy, I have a manager's salary of how much? 50,000 into 12, that's going to be 6 lakh rupees. In the other 2 alternatives, I don't have. Guys, correct? That's also an expense. Correct? Right? Then bad debts is given under each of the alternatives. That also needs to be reduced here. Guys, correct? Under each, this figure is given. So first, expected profit is going to be how much under each of the alternatives? 82.5, 87.5 and 86.5. Guys, any problem till now? Any problem till now? Any problem till now? No. Fine. Now this alone is not enough. This alone is not enough. Now I need to know, here I know that, look, under each of the policies, the amount that gets blocked is different, no? The amount that gets blocked is different, right? Which means the funding of working capital is different in each of these alternatives because of my credit policy. Guys, correct? So to the extent of the funding that I bring into the business, right, there is a cost associated to that. Guys, correct? So the cost of the funding that I bring in here should also be considered for the purpose of evaluating the policy, because if I change the policy, if I am increasing the credit period, right, which means more amount gets blocked, which means more funding is required, which means on that incremental amount also there is an extra cost associated to it. Guys, agreeing with me on this, right? So because of this decision, your cost of capital, I mean in terms of amount, is also getting impacted. Guys, yes. So that is also considered, and they are calling it as opportunity cost of investment in receivables. Are you clear with this? Yes, you guys are able to understand. That is one extra thing that you need to do. And how will you be able to do that? First, for that you should know what is the funding required. Correct? In this case, let's take the first part in the present policy. What is the funding required, guys? I know that for me to make the sale in a year, I'm making a sale of how much? 225 lakhs, right? And for that, ideally the cost is only 135. So 135 lakhs is going to be the cost of sales. Correct? That is the cost overall incurred in a year. Correct? Now I need not bring this entire 135, only one cycle equivalent of cost I need to bring in, because only I need to fund the first cycle. The other cycles will be taken care of by itself. But for that I should know what? I should know what is the period of the cycle. Guys, correct? Period of the cycle is not directly given, but they have given what? Receivables turnover ratio. We are just talking about receivables here. Correct? Receivables turnover ratio. Guys, yes? So this calculation, they have made it in months or in years. Okay, they have made it in months. Now tell me guys, so what they have done is, so here it's going to be in a year, they are going to, the number of the ratio, the receivable turnover ratio is 5 times, correct? So 12 divided by 5, what is it going to be? 2.4. How much is it? 2.4. Are you clear with this? So technically speaking, if I make a sale today, I will recover this money only after 2.4 months. Correct? Correct? Yes. So for 2.4 months, my fund is getting blocked. How much fund is getting blocked? 135 lakhs. Guys, correct? Are you all clear with this? So 135 lakhs is going to be the cost of sales, that is for the debtors, whatever is the cost that is getting blocked. This is the cost for 135, I mean this is the cost for one full year. But I just need to fund my first cycle. Correct? That is only 2.4. So into 2.4 by 12, that is the total amount of funds blocked because of receivables. Are you clear with this? Receivable line item alone for the first policy, this is the amount that gets blocked, and on that I am paying a cost of 20%. Are you clear with this? So on the first alternative, what is going to be my opportunity cost? 5.4 lakhs. Are you clear with this, guys? Any problem? Basically, this bracket is nothing but the amount of funds blocked because of receivables. Right? On that, it's 20%. I told you it's a long-term investment. It's a long-term funding that needs to come in. For the entire year, you will pay. That's why 20% is like per annum. Every year you keep, you keep paying it. This is the permanent funding that goes into the business. It will be given back, or it will be released only if you shut down your business permanently. Clear with this, guys? Yes. Similar calculation they have done for the other 2 policies also. Similar calculation they have done for the other 2 policies also, and they have arrived at the opportunity cost that gets blocked under each of the alternatives. Guys, clear with this? Yes. Are you all clear with this? Yes, you guys are clear with this? And remember, under the third alternative, they have taken 210 plus 6. That 6 is also a cost that is getting blocked into the business. Clear with this? So that's why they have taken 200 and 216, right? And they have arrived at 4 months is going to be my credit period. So to 4 by 12, this is going to be the amount that gets blocked in my receivables on the 20%. It's going to be 14.4 lakhs. This is how they have arrived at it. Guys, are you all clear with this? So now having considered that also, finally they call it as net benefits. And if you see under each of these three alternatives, just with respect to the items that are relevant to my receivables management, if you look at this second option, that is the alternative number 1, this is present, proposed 1 and proposed 2. The proposed policy 1 is reporting a higher net benefit, and hence you should go for it. Are you clear with this, guys? Are you clear with this? Any issues here? Any problems here? Clear with this? So the proposed policy 1 should be adopted since the net benefits under this policy are higher than the other policies, and that's about this. Fine, guys? Clear with this? Is it clear? Fine. Can we just go and update the library of adjustments? Yes, let's do it. Write down. Receivables management within bracket, evaluation of credit policies. Receivables management within bracket, evaluation of credit policies. Done? Right. So moving on to the next one. Now this is one interesting chapter, which is basically capital structure theories. Right? Now guys, under this chapter there are a lot of assumptions involved, right? And of course, in this chapter there are 4 theories that are being proposed: net income approach, net operating income approach, traditional approach, and MM approach. Under MM approach you have with and without tax, right? In this particular RTP, they are focused more on MM approach, with and without tax, right? That is what they are focused more on. Now this is actually a chapter that needs to be learnt in depth, but let me just give you an overview before we get started here, right? So basically what we do is, so generally this is how things look like. This chapter once again fits into the category of financing decisions. This is about your fundraising activity, right? Now when it comes to fundraising activity, what happens is, so basically this entire segment, they are assuming that there are only 2 sources of finance: debt, equity. Forget preference in this segment. There is not even a single because this entire theory means what? It's basically an assumption, or you can call it as a hypothesis. It is based on some assumption. I am coming with a particular my own theory, right? There are few people. Modigliani Miller is the name of 2 people, right? They have come up with their own research based on whatever assumptions that they have made. But those assumptions, are they valid in current world? Might not be. Some might not be, some are. So beyond that, we'll only have to dig the grave and ask them questions, but they have only written and they have gone away easily. But you guys are asking me questions, how can I answer? Because certain things, that was on a lighter note, but certain things they have said it. So basically why am I saying all this is because it's like a self-contained code. They have mentioned certain things and certain things are not logical. In fact, MM approach without tax is basically a copy paste of net operating income approach, right? He has just copied and pasted and he has given some 3 propositions, that's all, but for that there's nothing new in it. But anyways, coming back to this, what happens is, this is called as a net income approach, which is basically fair in all aspects. See, if you increase, we will say, debt as a percentage of capital employed. If you infuse more debt into your capital structure, basically what happens? Your KD generally will not change. Your KE also will not change. But because of infusing more debt, you are raising more money from a cheaper source of finance. Trading on equity effect happens and overall KO reduces. Clear? This is a thumb rule. This is only fair in all aspects. Correct? Because now you are giving more proportion to to a cheaper source of finance, what happens is obviously your overall cost will only reduce. Make sense? And always remember, KE will be greater than KD only. KE cannot be KE cannot be less than KD. If that is the case, then basically these are risk takers. They will expect more return, right? If you are paying them less return, why would they expect? They would rather go for a fixed, interest, fixed security, no? Are you clear with this? They would go for debentures. Clear with this, guys, right? This is what generally stands. Now, this is where the net operating income approach, or the approach as it's famously called, he comes and he differs. So basically, guys, what this NI approach says, net income approach says is, if you change the capital structure, the KO will change, correct? And when the KO changes, the value of the firm will also change. Basically, value of the firm is nothing but EBIT divided by KO, right? If KO changes, obviously your value of firm will change. This is the thumb rule. It's called as capital relevance theory. It says a capital structure decisions are relevant for the valuation of firm. Now here comes a guy, he says no, it is not like that. His theorem says, so basically what he says is, when I infuse more debt into my capital structure, what happens? KD will not change, right? But since I am infusing more debt, leverage effect will happen. Leverage is a double-edged sword. More risk means more return. Who is taking the risk? Equity share. So KE will increase. But he is saying KO will remain flat. Why? He is saying the increase in KE will be offset by this increase in this proportion of debt, right? That is his theorem. Not always the case. His theorem, right? Why? That's because he has said it and gone. That's all, right? Yes, honestly, yes. It might not, every time will it equally set off? Increase in the proportion of debt, can it always, your WD increase, can it set off your KE increase? No, it might not happen every time. But he says, right? So that's what we are just studying whatever someone has written and gone. That's all we are doing. Clear with this, right? So he says, no matter what you do, so even if your capital structure changes, KO will not change. When KO does not change, VF will not change. So basically what he says is, the value of levered firm is equal to value of unlevered firm. Levered firm means what? A levered firm means a firm which has some component of debt in it, and unlevered firm means an all equity firm. Clear with this, right? Fine. This is what he has said, and he has gone. And later on, when taxes were, this was like way so many years back, then slowly taxes started coming in, and he says now, that's why we have two approaches, without tax, with tax. With tax says that, okay, I'll make a small correction alone. So because of tax alone, your value of levered firm and value of unlevered firm will be slightly different. But I am not going back on my word. But for all other aspects, it will be the same. So he said that, and accordingly he has arrived at some formulas also, which again which can be mathematically derived, but which I covered in my regular classes. But right now, based on all these only, the next two sums are there. That's why I gave us a background of so much. Fine, guys. Now shall we get started with the next question? Right? This is what the long story short. This is what it says. Fine. Shall we get started? Yes. Come on, let's get started. So next question. Company XYZ is unlevered, meaning what? All equity, no debt in its capital structure. Fine. Which means what? Can I say KO is equal to KE? Yes. Yes, there is no debt at all. It has a cost of equity of 20%. Directly you can say that is equal to KO, right? And a total market value of, 10 crores, right, 10 crores. Now, this is one company called XYZ. There is another company called ABC. It's identical to XYZ in all aspects, except that it is levered. Basically, it uses debt finance in its capital structure, with a market value of 4 crores and a cost of 10%. Debt value is 4 crores, cost of debt is 10% given. Clear? Clear, guys? Find the market value of equity, weighted average cost of capital, and the cost of equity of ABC. ABC is what? Levered. If the tax advantage of debt is 25%, basically what are they asking for? Which approach? with tax. Clear with this? with tax they are asking for. Clear with this, guys? This is what they have asked for, right? Now, what with tax? What does he say? With tax, he says, this is question number 6, is it? right? Now, guys, this question they have solved it. I'll show you the solution. This is question number 6 now. Yeah. Okay. So look at this. They have given some complicated calculations and all that. Fine. Let's not get into it. I'll put it as simple as possible. Now, what says is value of levered firm is equal to value of unlevered firm, but now there is with tax, no? Because of the tax alone, there will be some incremental value for a levered firm. He says always when there is tax, levered firm will be more than unlevered firm. So he says it is equal to value of unlevered firm plus debt into tax rate, right? By the way, this formula is nothing but time value of money concept. That is nothing but whatever is the tax shield, tax savings they earn every year, no? Levered, unlevered, everything is same. Levered from what advantage do they have? On the interest component, they have some tax saving, right? So, like that it goes on till perpetuity. The present value of all the tax shields that you have, that actually they are adding it. That is all they are doing. Are you clear with this? This we derived in our regular class, but right now it's not required. Fine, this is what he says. Are you clear with this? So now you guys tell me, in this case, what is the value of unlevered firm? Is it given in the question? Yes. They have given the value of unlevered firm is 10 crores, 10 crores, right? Yes, 10 crores. Plus this company, the levered firms company's debt is how much? 4 crores. 4 crores into what is the tax rate? 25%. And how much is that? That's going to be 1 crore. So 10 plus 1, he says 11 crore is going to be the value of my levered firm. Guys, correct? Guys, correct? Now equity, debt, and this is the total value of firm. Correct? Total value of firm is 11 crore. Debt they have given us how much? 4 crore. How much is the value of equity? 7 crores. This is the balancing figure. Guys, getting it or not? Right? Fine. So with this, the first component of the question is being answered. Find the market value of equity, 7 crores. Now they are not stopping there. They are asking you for the WACC, and they are also asking for the cost of equity calculation and all that. Clear with this? Right? Basically, this guy has given a few other propositions. Based on that, he has derived some formulas. These formulas can be mathematically derived, right? But we don't have the time to derive all that right now. But yes, these are mathematically derived. So the formula that he has given is the weighted average cost of capital of a levered firm. A levered firm is going to be equal to KEU, means what? The cost of equity of unlevered firm, right? Plus, into, one second, I'm just erasing this off, into 1 minus debt into tax rate divided by debt plus equity. This is all he says. Now this is kind of related to, if you derive it, it is related to the trading on equity concept that we did, right? Because these guys have a tax shield and all that. This can be logically derived also, but right now we don't have the time for that. But yes, this is a logically derivable formula. Fine, guys, which actually I cover in my regular lectures, but right now we can't do it. Fine. So now you guys tell me, what is the cost of equity of the unlevered entity? Hello? Guys, how much is that? 20%, no? 20%, yes. Into 1 minus, what is the debt component? 4 crores you have, 4 crores. Into what is the tax rate? 25%. Upon debt plus equity is nothing but value of firm. How much is this? 11 crore. Correct, guys? So you just do it and tell me how much is it coming out to? It's going to be 20%, the whole into 1 minus. So 4 into 25 is going to be 1 crore. So 1 crore upon 11 crore. So overall it's coming to 18.18%. Guys, are you all getting this? See, if I open this RTP and show you that solution they have done is like kind of, it keeps going, but yes, the answer is the same, but this is based on a logically derived formula, right? Guys, getting it? Look at this, isn't matching with their answer. Look at this, right? So 1 minus BT into V, ABC and all. This is what it is. It is as simple as this. Okay, clear with this, guys? Fine. Now this guy Moriglani Miller, he goes on to derive one more formula. He says KE of a levered firm. KE of a levered firm. They have a formula here. So the KEU, basically the KE of a levered firm is, base is always KE of the unlevered firm, right? Plus KEU minus KD into D by D plus E. This is basically, can you see, this is similar to that trading on equity that I told you. The base plus whatever the incremental you get on the debt value divided by the total capital employed. Guys, clear with this, right? This is again logically derivable, but it runs into a few pages for you to logically derive it using all these formulas, but that's why I'm just directly giving it. But these are ideally certain things that he has proposed in his propositions. Clear with this. Once again, you just fill it up. Basically, what's your unlevered entities? 20% plus 20% minus, what is the cost of debt? What is the cost of debt? It's not 10%. Cost of debt, adjust it for tax rate. Guys, this is MM with tax. MM with tax. KD is going to be 10% into 1 minus point, what is T? 0.25, right? So it's going to be 7.5%. Guys, yes, are you clear with this? Are you clear with this? Yes, fine. Into debt upon debt plus equity, debt is going to be 4 CR, right? And debt plus equity is going to be 11 CR. Okay, so if you calculate it, guys, it comes out to 24.545%. Ideally, all these things will be very interesting if we do it in a regular batch because I derive it and then I do it. But here, due to obviously it's a revision batch, you can't do that. But generally, all these formulas are derivable. It's like not even a single formula in FM needs to be mugged up. It's all logical and derivable, right? So ideally, this is your answer. But in the institute RTP, they have like slightly done it in a very, very different way, but they have kind of approximated to this answer. The answer that they have got is yes, look, they have mentioned approx safely, but you don't have the luxury. So it's 24.28. What we got was 24.545, right? But it is actually the same. Nothing to worry about that. But ideally, this formula is what MMS he has provided, and this formula is only there in your study material. In your RTP, they have given another way of doing it. Don't get confused. It is like actually the same only. Guys, clear with this, right? But beyond this, explanation cannot be done at the moment. But generally, all these formulas are logically derivable. Like whatever MMS proposed, these are all logically derivable. But they all stem up from, as I told you, net operating income approach. But he has just coined a name, and that's about it. Guys, clear with this? Done, right? And I think that's about this particular question. Shall we just quickly go and update a library of adjustments? Right? So just do it. Write down. MM with tax. Levered and unlevered company, semicolon. Levered and unlevered company, semicolon. Calculation of VE, basically value of equity, you can write it as VE, value of equity, comma, WACC and KE. VE, comma, WACC and KE of unlevered firm. Using MM propositions. These are some propositions that he has given. But MM approach itself is a theorem. It is not very much applicable in real life. I'm just telling it to you, like if you go for a finance related job, it might not be useful in your real life. But whatever analysis that he did, maybe you can draw some kind of analogy from that, and maybe you can use it for if people are doing some research, maybe it's useful for that. But whatever end outcome that MM has given, maybe it's not relevant in today's life. Yeah? Hello? Yeah. So now let's move on to the next question. I think 3 more sums left. One on capital structure, one on leverages, and one on dividend decisions. I don't think it should take much time, so let's try to wrap it off as quickly as possible, or without diluting. Yes, guys? Yes, and really means a lot that you guys are staying back. Don't worry, I'll try my best not to extend. Okay, fine. Shall we get started? Yes, sir. Perfect, guys. Thank you so much. So now, 7th question. The following data are related to 2 companies belonging to the same risk class. Expected net operating income 18 and 18 lakhs. Right? For A Limited, 12% debt, it's going to be 54 lakhs. And for B Limited, it's nil, which means B is an unlevered entity. Good. And A is obviously a levered entity because of the presence of debt. Right. Equity capitalization rate, they haven't given for A, but for B, it's given as 18%. That's nothing but KE. Immediately, what can you conclude? KE is equal to KO. right? Clear? Clear with this? Now, required, determine the total market value, equity capitalization rate, there is KE, and the WACC, right, for each of the company assuming no taxes as per MM. Now, immediately tell me what MM says. Now, MM without taxes, what he says? Capital structure decisions are irrelevant. He says you bring any kind of mix in your capital structure, your KO will not change and hence your VF will not change. That's what he says, yes, right? So now which means value of levered company is equal to value of unlevered entity, correct? Yes. Right? Now in this case there is no tax also. I know this is my expected net operating income, correct? Right? So minus interest, nothing is there. Directly this is the earnings available for equity, right? And my KO is also 18%. So 18 lakh divided by 18%, 1 crore is the value of unlevered entity. And in an MM approach without tax, value of levered is equal to value of unlevered. Why? Capital structure decisions are irrelevant. It will not change, right? With this you will get your value of levered entity also. Guys, clear with this? As simple as that, right? And then we will proceed to the next steps. As we get the data, the missing figures, we can calculate. Clear with this? So, but for you to know this, you should know what MM says. That's why I gave a background. Clear with this? Right? Fine. So now, let's quickly get into this. Look, assuming no taxes as per MM. So value of A and B are according to MM hypothesis, unlevered firm. So what we did was the value of unlevered firm is NOI upon KE. Why KE is equal to KO, and that's the only source of capital for you, right? So that's going to be 18 lakh upon 0.18. That's going to be 1 crore rupees. Clear, guys? And they have given that KE unlevered, KE of the unlevered firm is going to be 18%. So the KO of the unlevered firm is going to be the same 18% since KE is equal to KO. Clear with this? And the market value of levered and unlevered is going to be the same. And is it with taxes? No, it is without taxes. So it's going to be the same 1 crore rupees. Clear with this, right? So in your MM with taxes, the value of a levered firm is going to be value of unlevered firm plus debt into tax rate. In this case, debt amount might be there, but tax rate is nil. Clear with this? That's why this need not be mentioned, because obviously VL is equal to VUL. Right, value of levered entity is equal to value of unlevered entity. Any issues here, guys? Right, fine. So now comes your calculation of KE and WACC. We are still in what? MM without tax, right? So now what happens? A limited, B limited. Net operating income, the starting point is the same, 18 lakhs and 18 lakhs. Clear? So now in A limited alone, there is a debt source of funding, 54 lakhs in the 12%. How much is that, guys? It's going to be 6 lakh 48,000, right? Fine. Is there any taxes? No. It's basically your MM without tax, right? So it's going to be what? 11 lakh 52 and 18 lakh, right? KO is equal to how much? It is going to be 18% for B limited, and MM says that capital structure decisions are irrelevant. Value of firm is not changing because KO is not changing, right? So KO is also going to be 18%, provided we are talking about without tax. It will change if it's going to be with taxes. Clear with this? That's why knowing the theorem is important. Right? Fine. So now comes your value of the firm, which is going to be your, which we already arrived at, 1 crore and 1 crore. Now in A limited, 54 lakh is the debt component it is given. If you reduce that, you will arrive at the market value of equity, which is going to be 46 lakhs, right? But anyways, for B limited, the market value itself is coming only from equity source. Clear with this, guys? Yes, you guys are able to follow this, right? And now you have the market value of equity, right? And you also have the net income available to the equity shareholders. So what is the KE? Is going to be 11 lakh 52,000 divided by 46 lakh is going to be 25.04%. Are you clear with this? Yes, are you clear with this, guys? Right? Whereas for B limited it's going to be what? The same 18%, and the weighted average cost of capital, that will not change. Why? Because this guy says the increase in your KE will get offset with the increase in your WD, the weight of debt. Clear with this? That is one weird proposition that he has given. It can happen rarely, but it cannot happen every time. But you need to take it with a pinch of salt, because this is what the guy has said, and they are asking the question as per his theorem only. Clear with this? That's why I said you should set aside logics when it comes to theorems. Theorems means whatever a person has said, you just need to solve the question based on whatever he has said. Clear with this? Maybe for this sum, if you do weighted average cost of capital based on our regular formula and all, it might not even match. Right? But still we need to do it in a certain way because it has been told. That's why I said it cannot be applied in real day life. Clear with this? Then why are we studying that? Okay, fine. Right, coming back, guys. Then the next one, they are saying suppose there is 40% taxes as per MM approach. Now will the value of firm be the same? No. So it will change, but the change what he says is purely on account of the tax savings. So value of levered firm is equal to unlevered firm plus the present value of all the tax shields that you get. That is nothing but debt into tax rate. It can be arrived at using your time value of money, but that's what it is, right? Fine guys, clear with this. So now what he says here is it's going to be yes, so the total value of unlevered firm in this case, what is going to be the total value? Look, from this 18 lakh, the entire amount is not available to the equity shareholders. Why? Government is going to take some taxes from you, right? So from this into 1 minus t, the government takes, so basically only 60% of that is available. You capitalize that using your using your KO, which in this case is going to be equal to KE only. So overall, if you see, now the value of the unlevered firm is going to reduce to how much? 60 lakh. Why? Because there is some taxes involved here. Clear with this, guys, right? So and the KE of the unlevered firm is given as what? 18%, and for unlevered firm KE is equal to KO. Guys, any issues here? Right? So now we have the value of the unlevered firm. Value of the levered firm you can calculate. It is nothing but value of unlevered firm plus debt into tax rate 60 lakhs plus 54 into 0.4. The value of unlevered firm is going to be 81.6 lakhs. Any problem, guys, here? Any problem? Fine, guys, clear with this? Right? Okay, fine. Now what is going to be the weighted average cost of capital for B Limited? KE is equal to KO, that we've already found out, right? That is not a problem at all. But for your levered entity, you need to do all the reworkings, but this time under with tax. Are you clear with this? That's why once again we are having this. So for A Limited is levered or unlevered? It's a levered entity. So net operating income is how much? 18 lakhs. The interest on debt, the figure is going to be the same, 6,48,000. You have EBIT. On that, reduce your taxes. You have your earnings available for equity shareholders. That is basically a net income, right? And we already have what? We already have the total value of the firm. For the levered firm only, we have it as what? 81,60,000, correct? Right? From that reduce the debt value, you get the balancing figure as your equity value, right? And there is another way of calculating your overall cost of capital. That is nothing but, look at this, your net income divided by what? Divided by your total, sorry, this is equity capitalization. Basically, this is the amount available for your equity shareholders. 6,91,200 divided by, what is it? Basically your equity value of 27.6 lakhs, you get what? 25.04%. That's going to be your KE value. Yes, guys, and your weighted average cost of capital. Now what you can do, you have the equity component, debt component with you. Guys, yes, now what you have the KE and KD. KD this time should be adjusted for taxes, right? Because this is with tax, 12 into 1 minus 0.4, you get what? So yes, this is going to be 7.2%. Yes, so now you have the debt equity value. With that you can arrive at the weights. You have the KE and KD. With this you can arrive at your overall cost of capital, which is going to be 13.23%. But the same question has now been redone under what? Approach with the taxes, and this is strictly being done based on what he has proposed. That's all. Are you clear with this? Right? The first base, the fundamental itself, whatever he says, this might not be relevant. That's what I'm saying. He says value of levered firm is equal to value of unlevered firm. The only change is because of the tax shields. That itself is a very not so correct assumption. But the entire solution was stemmed out of this because they have asked this question to be done under the approach with taxes. Clear with this, guys? Clear with this, guys? So you need to know what the theorem says for you to be able to answer these type of questions. Fine? Done? Yes, guys? Shall we just go and update our library of adjustments? Okay? Just write down. Please write down. It's descriptive capital structure. Within bracket, with and without tax. With and without tax. Semicolon, levered and unlevered company. Semicolon, levered and unlevered company. Semicolon, VF, KE, KO. VF, KE, KO. VF, KE, KO. Done, guys. Now let's quickly move on to the next sum, which is relating to leverages. Now, guys, a brief introduction here. Leverage, as we saw earlier, I was telling you, it's basically trying to get more benefits out of lesser efforts, right? That's what leverage is all about. Now, leverage, if you see, operating leverage as a formula, if you see, is nothing but percentage change in EBIT divided by percentage change in your sales, right? Or this can be represented as contribution divided by EBIT. Similarly, your financial leverage is going to be percentage change in EPS, or you can even say earnings for available for equity shareholders, both the same, divided by percentage change in EBIT, right? So, or in other words, you can say this is EBIT upon EBIT minus interest. If preference dividend is done, that also needs to be adjusted for. Basically, leverage happens because of the presence of fixed financial cost, financial leverage. Basically, leverage happens because of the presence of fixed cost, right? Operating leverage, fixed operating cost, financial leverage, fixed financial cost. Clear with this, guys? Now, is leverage good or bad? As I told you, let's say operating leverage is 2. It means for every 1% increase in my sales, my EBIT will increase by 2 times that increase. So it will be increasing by 2%. But if my sale drops by 1%, my EBIT also drops by 2%. So now what happens here? It's a double-edged sword, right? So basically, when you say risk, is risk good or bad? No, you can't say that, because risk refers to uncertainty, right? Uncertainty can happen either ways. If it happens in your favor, you will term it good. If it doesn't happen in your favor, you will term it as bad, right? But risk refers to uncertainty, right? So risk, you can't say that risk is bad, but a calculated risk or some level of risk is okay. Clear with this? Yes, that's how we always perceive it to be. Now when it comes to leverages, in this case what we will be doing is operating leverage is purely happening on account of fixed operating cost, correct? Fixed operating cost. Financial leverage is purely happening on because of fixed financial cost. Clear with this, right? Now if there is a change in my capital structure, right? Let's say I'm raising 100 crores, equity component, debt component, equity 60, debt is 40. Instead of this, I'm changing my capital structure to 80-20. This change will not impact my operating leverage. Agree or not? Overall capital is same. I have infused 100 rupees in the business. On that, I'm generating some operational return. That's all, right? So always remember, your sources of finance, your capital structure will not impact your operating leverage. It will only impact your financial leverage. Clear with this? With this, let's move to the next sum, and let me see if you are able to come up with the alternatives possible in this particular problem. Now look at this. The following data of PC Limited under situations 1, 2 and 3 and the financial plans ABC are given below. The company has an installed capacity of 3,600 units. The actual production and sales is going to be 2,400. The selling price per unit is 30. Variable cost per unit is 20. Now fixed cost, when they say fixed cost, it refers to fixed operating cost. Situation 1, 2, 3, 3 different options they are giving, or 3 different alternatives they are giving. Guys, yes. Next. Now apart from this, they are also giving capital structure, financial plans A and B. There are 2 different capital structures available, that is the sources of funding. They are saying in alternate 1, equity is 15 and debt is 15. Alternative 2 or B, 22,500 and 7,500. But if you see, overall it's going to be 30,000 in both the alternatives. As long as the total figure is the same, will my operating leverage change? No, I have infused 30,000. I am not bothered where, right? But the source of finance will only affect what? My financial leverage. That's where the trading on equity concepts and all kicks in. Clear with this? See how beautifully you can connect the dots. It goes around like, so trading on equity is a concept that revolves entirely in all your financing decisions chapter, right? It is there in your cost of capital. It is there in capital structure theories, leverages. Now all these chapters, it is pervasive, because that is the reason. Because of trading on equity, if your ROI is greater than your KD, you will say that your leverage is working in your favor. The moment ROI drops and it falls below your KD, now you will say that someone else is eating my piece of cake. Basically, from my share I need to give someone and I'm sacrificing something. The same leverage is working against you. Are you clear with this? That's why the trading on equity comes in. Now coming back here, so now what they are saying, now guys, you tell me how many, in this question, how many possible operating leverages are there? there are 3 situations given and 2 financial plans given. How many possible financial operating leverages are there? 3. What? 1. See, they are saying all 3 situations. 3 different fixed costs are there, no? So guys, yes, there are 3 possible operating leverages. How many possible financial leverages are there? 6. For each of these situations, 2 plans are possible. Are you clear with this? How many combined leverages are possible? Obviously 6, right? Combined leverage is nothing but a combination of 2, and if you have 6 financial leverage, obviously you will be having 6 operating combined leverage. Clear with this, guys? Right? Now that's about the sum. Doing and all is very simple, but you should know that there are only 3 possible outcomes for operating leverage and 6 possible outcomes of financial leverage. What have they asked for? Calculate the operating and financial leverage and find out the combinations of operating and financial leverage which gives the highest value and the least value. Now don't say which alternative is best. You cannot say. Is investing in share market good or bad? See, more risk, more return. Right? If you look at it from a return perspective, you will say yes, it is good. If you look at it from risk perspective, you will say bad. But without risk, return cannot come. But if you want return, risk is inevitable. Now what will you do? You can't give a one-liner answer saying yes or no. Right? That is the fundamental of finance. It is an open-ended subject. You can't come to a conclusion saying go for this. Now there are multiple capital structure alternatives. Which is the best one? From the viewpoint of EPS, I will say alternative 1 is good. From the viewpoint of return on equity, maybe alternative 3 is better. So you put everything on the table and you say you choose what you want based on from which angle you are looking at. That's a maximum you can do in FM. Right? That's the reason why there are a lot of hypothesis, assumptions, a lot of things involved. That is the reasoning. Clear with this, guys? Here also you do all these things and you can't say which is best or which is worst. You can only say this has a highest leverage and this has a lowest leverage, and that's about it. That ends the matter. You can't say go for this. Clear with this, guys? Yes? So now, see, this is what they have done. Operating leverage, only 3 situations they have done. Right? Sales, basically how many units? Sales is not going to change, no? 2,400 at the rate of 30. Sales figures are same. Similarly, 2,400 into 20. Variable cost is same. Contribution remains the same. Till this extent, it is going to be the same. But purely because of the change in fixed cost, what happens? Your EBIT also changes. Because of this, your operating leverage is going to be contribution upon EBIT. So here it's 1.14, here it's 1.13, here it's 1.60. Which is better? You can't say. Just now I said you can't say that this is better. You can at most say what happened. So you can at most say that this gets this has the maximum leverage and this has the least leverage. I mean operating wise I'm saying, right? And what you can do is, so then how can we take a decision? It's not like that. If you are looking for investing in a particular company where the industry is on a growth side, you are knowing that sure there's going to be a growth in this industry, then your decision will be tilted more towards that particular company that has a higher operating leverage. Whereas if you are not very sure about it, then you will definitely not go for the one that has a higher leverage. This is how financial planners plan all their the finances. Clear with this? This is one of the aspects. There are so many other aspects that need to be considered. Clear with this, guys? Done. Right? Going on to the next one. Now when it comes to financial leverage, what you need to do, there are 2 financial plans which needs to be recomputed under each of the situations. Right? Why? Because in situation 1 the starting point of EBIT itself is different. For that situation 1 there are 2 possible financial plans. Similarly situation 2 and 3. Clear with this, guys? So what they have done is, for situation 1, so the EBIT is going to be 21,000. This will not change. This they have borrowed from here. Right? So the interest on debt, how much is it? 15,000 into 12% for the first alternative. Second alternative, they have said it's going to be 7,500. Guys, correct? 7,500 into 12%, that's 900. They have arrived at the EBT and accordingly they have computed the financial leverage here. So financial plan A under situation 1 gives you a financial leverage of 1.09. Financial plan B for the same situation 1 gives you what? A financial leverage of 1.04. Clear with this? Similarly, they have done each plans under each situations and they have arrived at it and then they have tabulated it here. So what they have done is, okay, this is what they have done it here, and for combined leverage is nothing but operating leverage into financial leverage. So what they have done, each of the plan, right, under each of the situations. They have multiplied, see situation wise this remains the same, right, there are only 3 operating leverages, but 6 financial leverages are possible, and hence 6 combined leverages are also possible. Clear with this, guys? Clear with this, guys? So based on this, they have also arrived at the combined leverage figures and they have left it there. Finally, the above calculation suggests that the highest value is in situation 3 financed by plan A. So which has the highest leverage? I think this one, 1.82, right? Plan A under situation 3, and the lowest value is in situation 1 financed by plan B, that is 1.19. Now have they given any kind of decision? So they have just told that this has the highest, this has the lowest, and that's the maximum you can do, right? Beyond this, based on which company you are looking at, which trend you are looking at, that's how it happens. Clear with this, guys? Done, right? Fine, you guys are clear with this, right? So let's go and update your library of adjustments, and that's about this question. Write down OL, FL and CL, OL, FL and CL, semicolon, 3 situations with 2 financing plans. 3 situations with 2 financing plans. 3 situations with 2 financing plans. Done, guys, right? So now the last question. Is this RTP, am I right, or am I missing out on anything? That's right, the last question, I think the last 2, the other 2 are working capital we've done. There's one theory question that's direct, so there's no point in doing it. So yeah, fine, guys, shall we do it? Yes, right, so let's get started. Now this chapter is about dividend decisions. Okay, so this chapter is about dividend decisions. Now this chapter predominantly revolves around how much of dividend to pay and how much of dividend to retain. Right? Now, based on your dividend decision, your share value will change, right? And how will it change? It is being expressed by multiple people, just like your capital structure theories. One guy called Gordon, he says, use my formula. One guy called Walter says, no, use my formula, and he has his own justification for his formula, right? All the formulas are purely logical. Okay, clear with this? Which is right? Again, it is all their perspective that they have given. If you find their the logic and the assumptions that they have kept, if you find them relatable to your company, maybe you can use it. That's the maximum you can tell. That's why I keep telling this again and again and again. FM is an open-ended subject. You can't conclude just saying that there's only one answer. Clear? Just imagine if everyone in the share market wants to buy a particular share. Can they do it? There has to be a seller for you to buy. So if everyone thinks in the same mindset, there cannot be an economy at all, right? So based on what are the facts, based on your perspectives, based on your assumptions, you will maybe feel something is relatable. And FM beautifully dwells around this, and it says, I am putting all the options in front of you, you choose which you find is beneficial for you. It might be right or it might be wrong, but it is again your stand based on the justification that we have given. Clear with this, guys? Clear with this, guys? Based on this only, 2 guys predominantly, your Gordon and Walter. And again in this chapter there's he comes here also and he pokes his nose. Okay, so he says once again, dividend decisions are also irrelevant for my valuation. Okay, and he gives his own justification, saying it gets again offset in another own way, Gandhi Kanak only. So he does, and in his own way he gives that particular theorem. So predominantly these are there. Apart from that, there are some not so great theorems like Graham and Dodd and all that, but anyways, in this particular question that they've asked, it's about Walter and Gordon, right? These 2 are the models that they've asked, popularly asked models. And Gordon, anyways, you guys know. Walter model is again, it's 100% logically derivable using the concept of time value of money. I don't know how many of you have derived this, but it's actually, again, this is something that I generally tell in my regular lecture, which I derive and show. It's purely logical. It's 100% logical. I will explain the logic and all I'll leave. I will not derive. We don't have the time. Fine. Shall we get started, guys? Yes? Now, the following information is taken from Gamma Limited. The net profit for the year is 30 lakhs. To a 12% preference shares is going to be 1 crore rupees. Equity share capital of 10 rupees each. It's going to be 60 lakh. IRR of the company, 22%. Basically, the return that they are getting on their investment, effective return. The cost of equity capital is going to be 18%, right? Retention ratio is 75. What do you mean by retention ratio? So let's say I am earning an EPS, earnings per share is 10, which means out of this I will retain 7.5 rupees, 2.5 rupees will be paid as dividend. DPS ratio, DPS is 1 minus your retention ratio. Are you clear with this, guys? Right? Calculate the market price of the share using Gordon's model and using Walter's model. Clear with this? What does Gordon say? So KE is equal to D1 by P0 plus G. Correct? You cross multiply. They are asking you to calculate P0. P0 means basically your current market price per share. Correct? So can I say KE minus G is equal to D1 divided by PO? Yes. Correct? Or P0 is equal to D divided by KE minus G. Right? KE minus G. Okay, yes, KE minus G. Clear? Right? This is a simple logical derivation. Guys, clear with this? By the way, I am not sure how many of you are aware. This formula, no? This comes from your mathematics, geometric progression. Sum of infinite geometric progression series, this is also derivable. By the way, coming back here, every single thing in FM is derivable. It's all logical. You need not mug up even a single thing, right? But anyways, coming back here, this is how this is simple cross multiplication and you arrive at it. Fine, guys, done, done. So now based on this, let us do. Now in this question, they are asking, now the growth rate is a given. It's not directly given in the question, but there is actually a formula called G is equal to BR. B stands for retention ratio. In this case, retention ratio is how much? 0.75. And R is nothing but the return that you generate on your investment. That is basically your IRR. How much is it? 22%. Correct? Right? So you have this formula to arrive at your G also. The logic for this is nothing but the return that gets generated on whatever you are retaining. Correct? Whatever you retain, that alone can be invested, and on that only you generate your return. Correct? That's why G is equal to BR. That is the logic for arriving at this particular formula. Clear with this, guys? Right? Fine. So now based on this Gordon's formula, so the present market price per share is going to be what? It's going to be D1 divided by KE minus G. Right? So what is going to be your growth rate? I just told you, BR. Right? It needs to be written, guys. The formula needs to be written in the exam. So B stands for retention ratio and R is your internal rate of return or return on investment. You can write anything. So it's going to be 0.165. So here your earnings price per share is going to be, so how much have they mentioned here? How much have they mentioned here? So first you need to calculate the earnings price per share. Correct? On that you need to apply your dividend payout ratio. Dividend payout ratio is 1 minus retention ratio. Guys, correct? So for that you need to have a working note. Calculation of EPS. So they have given the net profit is how much? 30 lakh rupees, right? 30 lakh. There is a preference payment of how much? 12% on 1 crore. That's going to be 12 lakh rupees. So you have the net earnings available for equity shareholders. No taxes in this question. They have not given it, right? 18 lakh. So the number of shares is going to be 6 lakh. So 18 upon 6, that's going to be 3 rupees per share is going to be your EPS. Fine, guys. And the retention ratio is 75, which means 25% of whatever I've earned, I'm going to pay it out to my equity shareholders. That's going to be 3 to 0.25. It's going to be how much? 0.75, right? 0.75 is my current dividend, right? But what does Gordon say? Take D1, the next year's dividend. So how will you do? So 0.75, the current year dividend into 1 plus G into 1 plus 0.165. 1 plus 0.165, that is 16.5%. 16.5% is nothing but the growth rate that we just calculated. Guys, correct? Understanding? Yes, right? And divided by K, this figure is there. G, this figure is also there. Guys, correct? Yes. With this, if you arrive, you will arrive at the value at how much? 58.25. Fair enough, guys? Fair enough. Any issues here? Any problems here? Right. Now let's move on to the next one, Walter's model. Now, Walter has this beautiful model, once again based on the concept of time value of money, right? What Walter says, again, instead of reading this formula like this, okay, so generally if you have attended my regular batch, again you would know this. I would again and again I would have told you, don't mug it up like this or don't read it like this. Rather you put it as D divided by KE plus R into E minus D divided by KE square. You do it like this, it is logically understandable. What Walter says is very simple. What Gordon says, present value of dividend alone you take. He is completely ignoring your retained earnings. He is assuming that retained earnings is not even a part of, it will not impact your share value, but technically speaking that is also belonging to whom? The equity shareholders. That's where Walter comes in and says, no doubt D divided by KE. So take the present value of all the dividend, but what Walter assumes is dividend is going to be constant, it will not grow. That is what Walter assumes. For that assumption only Walter's formula can be used. If dividend is growing, go to Gordon, that's all. Clear with this? So he says D by KE, that's nothing but annual cash flow divided by the discount rate, correct? That is the your time value of money formula. Discount your dividend plus what happens is you are having some retained earnings, right? That gets invested to the next year. Out of that you generate profit, and out of that you pay dividend, and once again out of that there are some retained earnings, and that also gets reinvested back. Like this, every year there will be some amount of reinvestment, on that there will be some profit, on that there will be once again some reinvestment, and it keeps on going on and on and on and on. So basically he says this is the present value of the return generated on every year's your retained earnings. This is what he says, and this is also provable. So if you use the time value of money concepts, once again this is also provable, and this is also logically derivable, just that it runs into about 1.5 or 2 pages, right? But this is also very logical. What Walter says is take the present value of dividend and also take the present value of all the returns on all your retained earnings. That is what he says. Are you clear with this? That's where I said this is nothing but sum of infinite geometric progression series and all. You can derive this, but we are not here for that. So if you use it, this is what is the formula that he says. Clear with this, guys? Now based on this formula, if you logically apply, dividend is going to be how much? 0.75. There is no concept of growth when it comes to Walter. Clear with this? There is no concept of growth when it comes to Walter. If there is growth, then Walter cannot be used. Clear with this, guys? Right? Plus R into E minus D. So basically E is what? Earnings. D is what? Dividend. So E minus D is what? The amount that you have invested back. On that only R, the return can be generated. Are you clear with this? Right? R into E minus D upon KE, right? The whole divided by KE. It cannot be just like that. I cannot tell you the logic because this is actually derived through the time value of money concepts. Clear with this? So here you just need to plug in the figures and you will arrive at this figure of 19.44. Now just see the very same company, right? 2 different models are giving extreme values of the shares, right? This is where if a person, let's say if you are in the market, you are there, you have followed Gordon model, right? And you feel that the value of the share is 58.27. Let's say the value of the share is 58.27. This is what you feel. Okay. So now let's say in the market, the company is being currently, the market price is quoted at 25 rupees. In the market, the company is currently quoted at 25 rupees. You do the valuation as per Gordon's model. You saying that this company is worth 58.27. But in the market it's quoting only at 25. What will you do? You will sell it. It's overvalue. Sorry, what? See, this is the value that you are attaching, but it is being valued in the market at only 25 rupees. You're saying that the value of the company is huge. In the market, I'm readily getting it at a cheaper price. You will go and buy it. But when you are buying it, who will be ready to sell? The person who would have valued it under Walter's model. From his viewpoint, the company's worth is only 19.44, but in the market he's getting 25 rupees. He will sell it. This is the reason why there are buyers and sellers in the market. Now are you able to understand? Right? Based on the methods they follow. Are you all clear with this? Right? This is where the concept of undervaluation, overvaluation comes in, and an extended leg of that is your arbitrage model. Right? Clear with this? Arbitrage is like another extreme level. In your final you will see more of that. In your intro there's only some 2 or 4 questions, if I'm not wrong, in your study material that are also very, very specific and very hand-picked, and that's about it. Guys, are you all able to understand now? This is where it all leads into, right? That's where they say using the right model for the right approach is very, very important. Guys, clear with this? Yes, let's quickly note down our library of adjustments. Write down. It's going to be descriptive dividend decisions. Yeah, and the concept write down. Calculation of market price under Gordon and Walter models. Under Gordon and Walter models. Done, right? Fine. So that's about the RTP discussion. But before we conclude, I just want to share one small thing. Now, guys, you know, I know many of you might have got this kind of a mindset, predominantly looking at the first question of your case study based MCQ. So what if this question comes in? So now if such question comes, as I told you, first attempt it at the end. The most important thing in CA exams is having the right mindset. And I can't, beyond this, I don't know how much I have to say. I mean, I don't know how to emphasize this beyond. But trust me, guys, it makes a lot of sense only when, you know, that's why half the students, they fail even before they enter the exam hall because of that fear, right? So many of you might know this, I've shared this many times before. I am not a first attempt CA. Foundation and inter, I was a brilliant performer and all that. Final, I took 8 attempts, 4 full years for me, and out of that I could write only 3. 5 attempts I didn't write. Out of the 2 attempts, because of fear of failure, I skipped. So now I only want to tell you guys one thing. How did it fix? It's simple. I changed my perspective, and the perspective for me took that long a period of time. But I don't want you guys to fall for you know, these kind of things, because I know that I wasn't, back then I was thinking I was the only one, I was alone, I was the only one thinking like this. It's not the case. Literally almost every CA student goes through it. Just that how you handle that pressure is what makes the difference, right? And when you are approaching the exam hall, there will be surprises. If it's going to be a cakewalk, then every Tom, Dick and Harry on the street can become a CA, and then CA will lose its value. So understand that you are writing a professional exam, which is like a very highly rated professional course. There, more than anything, it's your confidence level and your mindset that matters the most, right? So how do you do that? Have developed that level of you know, patience. First of all, don't be very quick in judging what a question is going to be. Right? Yes, there will be some riders. All you need, see, we don't look at it rationally. What do you need? First, you need 40 marks, right? For so much efforts that you guys have put, don't you think you can score 40 marks? Guys, don't you think you can score 40 marks? The problem is, we don't look at the big picture. When a particular thing comes up, we only focus on the specifics, leaving the big picture aside. And in the process, we also lose out on the ones that we ideally should have done well. Right? This is what it is. And for me, it took, you know, I was so dumb that it took such a long period of time for me to realize what I did. Right? And finally it came out. But I don't want you guys to repeat. That was when really, had it not been for those 4 years of whatever phase that I underwent, I would not have got into teaching profession. The main reason why I got into teaching profession was I wanted to make sure that this at least does not happen back to my students. And at least if someone is able to resonate to it, or someone is able to understand this, maybe that will be, you know, that means a lot to me. Because at that point of time, wherever I went, people were always focused only on the content, the subject, technical aspects. No matter, I finished my final preparations 5 months before the first attempt. And still it took 4 years for me to finish. What do you think it is? I didn't prepare well, is it? Definitely not. It's just about, I learned everything conceptually. I never used to mug up and all that. It is just purely because of, you know, that fear of failure, right? We all have it. It just depends on how you handle. If that fear is just this level, maybe yes, you will be able to, you know, you will be able to just compress it. But if you let it grow, then it will just overtake you. But I'm not saying at the same time, you know, that little bit of fear is good. So don't say, sir, fear illan soltare, so I'll just go out and party. No, that's not what I mean. Have some sense of responsibility, not fear. That's what I meant. Okay, guys. So you all are doing a very great job. Trust yourself, trust the process. Do not worry about the results today. Results is not in your control at all. When I was preparing, I was focused on that day when I'm going to get the result. In the process, it put more pressure on me and I just couldn't do my best. Right? So right now, I'm telling you guys, it's difficult, but it is 100% possible. You're just, what, a couple of weeks away from your exams. Right? Right now, what you need the most is not, just breaking your mind and just reading so many things. Have that, mental stability. I think whatever you read, you guys are putting a lot of efforts. Else, sitting for this long a period of time is no joke. Really, it's like, it shows your dedication level. And if you are dedicated, if you're sincere, hard work never fails. And I am a strong believer of that. right? And I'm sure you guys are going to make it really big in your life. Okay, guys? Fine. So that's about it.